Hey, Eric, long time no see.
Hey, Mark, how are you?
Good, good.
Um, so before you start, I'm going to introduce you. So this
Perfect.
is this is for the audience. I'm pleased to introduce my friend Mark Mazer as our keynote speaker. Mark is the acting assistant secretary of tax policy at the Treasury Department. Before that, he was director of the Tax Policy Center, and before that, he was director, assistant secretary of tax policy in the Obama administration. And before that, director of RAS at IRS, many other positions, which I won't mention. So Mark, we're delighted you could join us today, and we look forward to your comments. And before you start, I just want to remind the audience to put your questions into the Q&A box.
Okay, well, thank you, Eric, and good afternoon to everyone. It really is a pleasure to be with you all today. I feel like a little bit back home with colleagues and friends. I'm now working at the Treasury Department, as Eric said. I'm the Deputy Assistant Secretary for Tax Policy. I'm also acting Assistant Secretary until our nominee gets confirmed. But I retain a keen interest in both the tax research area and also in tax administration. And so that being the case, I'm just incredibly happy to be able to speak to a conference that combines those two things. I also have a keen interest in this particular research conference, having worked both at IRS, as Eric said, in the RAS organization, and at the Tax Policy Center. And the co-sponsorship of this conference between these two organizations really combines the talent of these two distinct entities in a way that has developed and presented a consistently top-notch program over the years. In preparing for the talk today, I did a little bit of reconnaissance of the history of the IRS Research Conference, and I'm just struck by several distinct factors that history embodies. One, just how the conference and IRS research activities have evolved over the years. Second, just how tax administration itself as a topic has broadened to cover many new topics. Third observation is just how research partnerships have deepened both across the IRS, across the federal government, between academic and government researchers, and across various disciplines. It really is gratifying to see essentially the footprint of tax administration research growing essentially year by year. And then last observation, just how the research done for this conference and presented at this conference, along with the other tax administration research that goes on, has really affected our understanding of a wide range of activities. And so let me take these in turn. First, the evolution of research and the IRS conference. As the IRS research activities have gotten more attention over the years and grown in size and scope, more attention has been paid to these activities and their implications. The IRS has built out both service-wide research units and also domain-specific units in the operating divisions, in the Taxpayer Advocate Service, and elsewhere. And all of this has really increased the reach of the research community, as well as the reliance that the IRS management has placed on the research results. And just one example of the evolution of the IRS research conference may help illustrate some of the shifts that have occurred. In the early days of the IRS research conference, number of the presentations emphasized things like counts and amounts. And this essentially would be things like how many taxpayers demanded a particular kind of service, or how many interactions there were between a particular type of IRS employee and the public, or how many returns of a specific type were processed, and various types of service delivery options that might be used, and even things like levels of taxpayer satisfaction. And these efforts were all foundational, because until you have the measures and the data, you really can't do very much in the way of research. And so just collecting this information and thinking hard about how you want to frame a problem, how you want to obtain the right information to look at that problem, and where to go to get that information were just all key efforts that were really quite foundational. And they really were needed by the IRS to help arrange activities and resources to more effectively provide taxpayer services, and also to provide better options for taxpayers. Largely, I guess this is all now put under the heading of the taxpayer experience. But this strand of research really provided important insights into IRS operations and allowed IRS senior management to make adjustments needed to improve overall efficiency, to improve the delivery of services, to improve customer satisfaction. And these efforts also help the IRS transform. This is in the wake of the Restructuring Act of the late 1990s, to help the IRS transform from a geographically based entity with regional offices and the like into one that really viewed its operations and activities from a national perspective. And if we look at recent contributions to the IRS Research Conference, as well as other contributions to IRS activities, we see new sets of research activities. These include things like randomized control tests to better understand how taxpayers respond to different treatments. They include new and innovative methodologies, either new methodologies from a computational standpoint or from a statistical standpoint, or new methodologies from a research standpoint. So incorporating survey research into the work that we do, or other types of qualitative research into the work that we do. And even doing things like on the disclosure side, looking at concepts such as differential privacy to figure out ways to better ensure that taxpayer data is not inappropriately disclosed, but that important implications from that data can be gleaned and published. Also, we've seen use of natural variation in data to help tease out treatment effects. So looking at potentially geographic differences or timing differences or other types of natural variations that may occur. And we also have gotten deep insights into new and existing research problems. And so all this just is a very positive trajectory for all these IRS research efforts. Second point I wanted to focus on is just the broadening of what constitutes tax administration. In recent years, I guess actually recent decades, Congress has used the tax code more intensely to deliver social benefits. Examples include things like incentives for work, the earned income tax credit, for instance, incentives for affordable housing construction, so things like the low income housing tax credit, incentives for people to attend institutions of higher learning, so the American Opportunity Tax Credit, for example. Support for families with children, the child tax credit that has been recently expanded. And this list is nowhere near exclusive, but it does indicate a shift in the way that the tax system works. It is not exclusively the textbook example of this is how we raise revenue that we need to provide goods and services for the federal government, but it's also a way that benefits get delivered to households. And on that area of benefit delivery, the Congress saw that the IRS was able to deliver these tax incentives and decided that the IRS could also be used to deliver payments to households during times of economic stress, such as the 3 rounds of pandemic-related economic impact payments. All these steps really help blur the line between traditional tax administration and traditional benefit administration. And this broadening of IRS activities opens up whole new ranges of research questions. They include things like, how do we reach households that do not ordinarily file income tax returns, or do not traditionally interact with the Internal Revenue Service? How do we structure payments so that they have maximum effect to the households that receive them, or that they provide the appropriate behavioral incentives? And also, how do we measure success for these programs? It's in traditional, some traditional IRS metrics are things like dollars collected per FTE, or dollars collected per dollars appropriated. But these are not really the right metrics if you're going to be doing benefit administration. And so you really need to think through what those measures of success might be. And IRS researchers are contributing a lot in these areas. Studies have examined what types of communications work well with households, and whether taxpayers respond, or how well they respond to different types of behavioral nudges. And there are big economic implications of this work. If we can learn how best to design tax incentives for things like higher education, we can help improve the future productivity of the workforce. And that would have substantial benefits to those households, obviously, who would then have higher earnings potential, but also substantial benefits for the economy as a whole. And really those can be hugely important for the future of the U.S. economy. Third item I wanted to review is the role of research partnerships. And one of the most gratifying aspects of reviewing the past research conferences has just been observing the growth of research relationships across organizational boundaries. And so we now routinely see IRS researchers co-authoring papers and conducting studies with counterparts from academia, or elsewhere in government, or in nonprofit think tanks. And this cross-pollination has many substantial benefits. From the IRS standpoint, IRS researchers get exposed to new research techniques that otherwise may not be available to them. They get exposed to different ways of thinking about problems, some sense broadening the aperture of ways they look at things. So it's not just the narrow focus of what it means for IRS, but somewhat broader for what it means for society as a whole. And this really helps improve the human capital of these researchers, and makes them better and more accomplished researchers. And so that is all to the good. And the non-IRS researchers get a lot of benefits as well. They get exposed to details of tax administration that may not be readily apparent, and the constraints that the IRS operates under, which also may not readily be apparent to outside researchers. They get, in addition, they get access to data sets that might otherwise not be available, and they get access to experts in tax administration who otherwise might not be available to them. And these partnerships also provide then feedback on basic research infrastructure. They've led to improved data collection techniques by the IRS. They've led to improved data sets, and they've led to improved research techniques. And so I think these partnerships really help provide deep insights into the effects of IRS policies and processes, but also shed light on non-tax policy interventions and longer-term trends in the economy. And there's intense interest across the IRS on the implications of, intense interest across the administration on the implications of tax policy. Just one example is the White House has an equitable data working group that's interested in understanding things like racial disparities in the delivery of economic impact payments. Obviously, we don't have data on the income tax returns indicating the racial composition of households. But the research question that this poses is whether we could use other data sets across the federal government. Maybe they'll be helpful for understanding questions like this one. And this really becomes a live research project. It brings into focus issues around data disclosure, around imputation techniques, around legal constraints for data sharing across organizations, and also a recognition that we have various data silos throughout the federal government that not always are accessible to other researchers. I'm optimistic that projects like this will yield some important insights, and I am sure this is these types of research projects are areas where policymakers will have a real interest in understanding the implications. Last topic I want to mention is just broadening our understanding of tax administration issues. Lots of the work presented at this conference over the years has had broad policy implications. I just want to highlight two examples. One is work on the tax gap. For years, IRS researchers have devoted countless hours to estimating the components of the tax gap, to developing better measures of the elements of the tax gap, developing more precise ways to take existing data and project it, to develop estimates of how much tax has not been paid timely and voluntarily. And all this work has supported the Biden administration's proposal to improve tax compliance in two dimensions. One is to increase information reporting on financial flows to and from financial institutions. And we all know that increased information reporting should increase voluntary compliance. And so this is one area where I think the work that's been done by IRS researchers over the years really contributed to better understanding of what can move the needle on overall compliance. And then second, there's a proposal for substantial multi-year funding for the IRS. The idea being that with additional resources on the enforcement side, but also across the board in IT and research and human capital and so on, that these resources have a positive return on investment, a positive long-term return on investment. And so we estimate that taken together, the proposals would raise somewhere in the order of $700 billion over the 10-year budget window. And this is really something that's gotten attention from people in Congress to see if there are ways to provide the additional resources to the IRS so they can be more successful at collecting the taxes that are owed under the laws that Congress has made. And the second example that I want to focus on is research that involved correspondence with taxpayers. In this particular example is where the IRS sent out correspondence to taxpayers who had not had healthcare coverage and who owed an individual responsibility payment. Obviously, subsequent to this study, this payment has been reduced to zero. But the research indicated that a number of people responded to this correspondence from the IRS by obtaining healthcare coverage. And so normally we expect some subset of people to respond to correspondence by the IRS. But this particular form of response of obtaining healthcare allowed researchers to then look at subsequent issues, like what was the mortality rate for people who obtained health insurance coverage. And it turned out that um, the mortality rate was lower for people who had health coverage than people who did not. And this really is a major finding in the health economics research coming out of the tax administration side of things. Um, but it really does show that tax research truly can be a matter of life and death. Okay, I couldn't resist that. Let me just summarize by thanking the sponsors for inviting me to be with you all today to celebrate the important work that you do, and to note that these are major contributions to help advance our nation's tax system, and so they're quite important. And over the years, I think they've really added up to an incredibly valuable body of work. And with that, I'd be happy to answer any questions you may have.
Okay, Mark, I don't have anything from the audience, so I'll start out and hopefully others will follow. I was struck by two things you said. One was about the tax gap and the importance of it in encouraging policies, and particularly motivating proposals to increase funding for the IRS. But before that, you said the IRS shouldn't be thought so much of as a tax collection agency, but more as a social program delivery agency. And I was wondering what the implications of that might be if people were to start thinking of the IRS funding as funding social programs as opposed to funding tax enforcement, and how that might change the view. It wouldn't just be about, the focus then wouldn't be about how many dollars you raise, but how well you deliver benefits.
No, exactly, and that's the, I think, one of the important evolutions of the Internal Revenue Service. That 50 years ago, the focus was almost solely on how many dollars that you raised and how effectively you did that, how efficiently you did that. And over time, the IRS now has a dual role, both administering a tax code and collecting the revenues that are owed, but also administering a number of social benefit programs that are run through the tax code. And so there's a blurring that kind of goes on there, and it's it just makes for a much more complicated agency, a much more complicated organizational structure, because you need to be able to do more than one thing well, right? You need to be able to collect the revenues that are needed to fund the goods and services that citizens demand from the federal government. But you also need to be able to find ways to deliver the benefits that Congress has determined could best be delivered through the tax code. And so it really is a little bit of a game changer for the IRS to think about those different structures and how best to deliver on both of those mandates.
Well, I had another question in my mind, but Howard Gleckman raised it, so I'll make him responsible for it. Howard wants to know, are there any implications of the ProPublica leak for IRS information sharing with outside researchers?
Yeah, so I mean, obviously, incredibly serious issue. The IRS and Treasury have turned this over to the investigators to look at. We all know that disclosure of tax information is criminal activity, and so this is one where it's going to take a little bit of effort to get to the bottom of this and see what the implications are. Obviously, we don't have any information about where this tax information, where it got disclosed from, who disclosed it. As that information gets determined and becomes available, then people have to figure out what the right steps are. It obviously does call into question the work that we all do using tax data, and should really make us redouble our efforts to ensure that disclosures are rare and addressed if they occur.
All right, unfortunately, so far I'll only have questions from the Tax Policy Center. So, oh, no, I've got a new one from Alex Turk. I'll let him jump the queue. Alex asks if as we consider more information reporting requirements, are we considering both the increase in compliance transparency, but also the reduction in overall burden because most information documents help taxpayers comply? That's actually an interesting slant on it. It's reduction in burden as opposed to increase in burden.
No, that's exactly the point of some of the information reporting that the administration is asking for in the budget. The idea would be to get information on cash inflows and cash outflows from financial accounts, and then the IRS could use that information in more sophisticated ways, because it's not just a matching program, to determine whether taxpayers need to have another look at their return. So one example I like to use is if you have $1 million of inflows and $1 million of outflows in your account, and your adjusted gross income is $25,000, maybe you need a look. But as Alex points out, this would also indicate situations where taxpayers were reporting the right amount. If you have a taxpayer who, say, has a small business and runs it through a Schedule C, and they report gross receipts and expenses, and those seem to match up pretty well with the inflows and outflows account, well, then that person doesn't need an audit, right? And so you really would have a situation where taxpayers who are compliant would not have to be burdened with audits. And so there is that benefit as well.
Okay, this is from Robert Weinberger. There has been some pushback against the multi-year IRS funding and the collection of information on financial flows from banks. Are you confident of winning on both issues?
So my current job has me be an advocate for the administration. So of course I'm confident on this. No, this is an area where look, the IRS has been underfunded for years, and we all know that you really should not underfund your accounts receivable department. If this is a private sector business, we wouldn't be underfunding the accounts receivable department. So you shouldn't underfund the IRS. In addition, the IRS is one of the agencies that touches just about every household in America. And so they should be providing world-class service to those households. And the service should be on the par with what we all get from our financial institutions. And that's not the case today. So to address that, you really do need a long-term commitment to fund the IRS. So it's not just a 1 year bump up and then a several year decline, but really is a long-term commitment to being able to deliver the kinds of services that taxpayers want and demand, but also deliver the level of enforcement activities that are really implicit in the laws that Congress passed. Congress passes laws. They expect to raise the revenue. We have a tax gap that is approaching probably $600 billion a year now. That's a huge difference between what Congress intended and what is being collected. And so we should make some efforts to put a dent in that.
Thank you. So Gene Sterling asks, says you've commented positively on sharing data across agencies for tax research. What about more sharing of both data and actual compliance efforts for this social service function, e.g. SNAP and EITC? This would run counter to each one maintaining its own privacy constraints.
Yeah, this is an important issue, right? To think about how going forward you want the federal government to be interacting with citizens across a range of activities. And Gene's right that over a number of years, we've created a number of siloed programs to provide benefits to households. And kind of stepping back and taking a look at the range of programs and seeing if that's the current structure is the most efficient way to deliver them is certainly warranted. It's a long-term issue, one that would take a lot of study to figure out what the trade-offs are. But if you can get a situation where you can deliver benefits more efficiently and more equitably, that's really a real positive step. So it's actually good to hear from Gene. It's almost like old home day. I'm just hearing from Tax Policy Center.
About 5 minutes left, so we have time for a few more questions. There are two from Richard Bartholomew. He says in the late 1960s, the DOT, I think he means Treasury, presented a study that revealed many high-income taxpayers paid little or no taxes. This led to the minimum tax on many tax preferences. The top preference was capital gains. He also wants to know, why doesn't the OTA conduct a similar study now and include wealth?
Okay,
So in your OTA role.
So that's a good question. So the first part, really interesting little bit of history, right? That in the late 1960s, I believe it was outgoing Treasury Secretary put together a list of the couple hundred people who had high incomes and paid no tax. And since then, I believe the SOI division has been publishing every year a study of how many taxpayers have incomes above, I think it's $20,000 and paying no tax. And he's right that led to the development of an alternative minimum tax, a way to try and address that. The recent interest in wealth tax just acknowledges that there are, well, wealth and taxation acknowledges that there are gaps in the way that we tax capital income now, and we tax it much less heavily than labor income. And so you can have situations where a person builds up large amounts of wealth and pays virtually no income tax, or very low income tax rates over their lifetime. And part of what the administration is proposing to do in its budget is to address some of those issues by changing the way capital gains are taxed, proposing to tax capital gains at death, and you just ensure that at least there's a little bit more of an equalization between the way labor gets taxed and the way capital gets taxed. The question about OTA doing a study on wealth is an interesting one. I don't know where there are really good data sets to do that. Obviously, the Survey of Consumer Finances at the Fed is a wealth study, but not matched up very well with tax data. But I guess there are things that can be done. I just have this recollection that Gene Sterling did some work on this number of years ago, showing that there were very, very, very low tax rates as a share of wealth, probably around 1 or 2%.
Okay, and here's a question from Jacob Golden. He says, you mentioned the benefits of collaboration between IRS researchers and outside academics. And Jacob wants to know, what would it take for the IRS to expand such programs to increase opportunities for that type of research?
Yeah, I think that obviously a question better asked of the IRS participants. My sense from having worked at IRS and Treasury is just that part of it is a resource issue. Just having the staff and the time to be able to encourage those collaborations, and it's something that does pay benefits. Obviously, the payoff from an IRS standpoint has to be positive and tangible in order to get the upper management of IRS to devote resources to that. But that seems to be doable. I just like to point to a lot of the successful research projects that we've had over time, and think of that as almost like a set of advertisements for putting a little bit more resources into that area.
Okay, I have two more questions in the queue, so I think we have time for them.
Okay.
One is from Robert Kerr, who asks, they're quite different questions.
Mhm.
How does IRS partner with private sector actors, which increasingly have large data sets and experience in working to assist taxpayers, both pre-filing and post-filing? And the other is from an anonymous attendee who wants to know what impact you see on voluntary compliance if people feel the wealthy are not paying their share. I think that's also related to ProPublica's
Yeah.
disclosure.
So the first question, I really don't have a great line of sight into the activities of the IRS and private sector folks who are good and used to using large data sets. I mean, obviously there's a fair amount of learning that can go on there, but I really don't know enough to comment about the possibilities. On the second point, Vanessa Williamson at Brookings Tax Policy Center has written about this, and there's a whole literature on kind of tax morale, that if people feel the system is unfair or tilted against them, they are less likely to take steps to comply or conform with that system, and that goes for the tax system as well. And so obviously, if people's faith that the tax code is administered fairly, efficiently, equitably gets eroded, that should show up as a erosion of voluntary compliance. And obviously that's, once that gets started, that's hard to reverse. And so you really don't want to be in a situation where we have to fight against that, which I guess goes back to the point of investing in the IRS to ensure that the tax system is administered efficiently, is administered equitably, and that the public understands that. It's just a way to ensure that you have a well-functioning tax system, and frankly, it undergirds a well-functioning federal government going forward.
Well, I think we're out of time. That's certainly a good note to end on. And thank you very much. I'm now going to turn the program over to the third panel, which will be moderated by Terry Ashley. Terry is a senior research analyst at the IRS Taxpayer Advisory Service. So on to you, Terry.
Thank you, Eric. Welcome to session 3, Developments in Technology and Analytics for the 11th Annual IRS Tax Policy Center Joint Research Conference on Tax Administration. Again, I'm your moderator with the Taxpayer Advocate Service. Our 3 papers for this session are New Approaches to Estimating the Extent of Non-Filing. That'll be presented by Alan Plumley. Plumley's with the IRS Office of Research, Applied Analytics and Statistics, RAS. He's a 36-year veteran of IRS, work in compliance measurement and modeling. Our second paper, Using Uplift Modeling to Improve ACS Case Selection and Compliance Outcome, will be presented by Jan Miller. Jan is also with IRS RAS, equally a 36-year veteran of IRS service, expertise in applying behavioral insights to notice design and case selection work. Our third paper, Recent IRS Discriminant Function Model Improvements, is presented by Gatana Ismont. Ismont is also as well with the IRS RAS office, 10-year IRS vet, research in predictive workload selection modeling. Our discussion for this section is Brian Erhard, has an economic consulting practice in DC, specializing in tax compliance enforcement and administration. Just again, a minor housekeeping items. Presenters have 20 minutes, discussants 15 minutes. Participants, please use Q&A at the bottom of the Zoom display for your questions. Please use 1, 2, or 3 for your paper. I thank you, and I now turn it over to our first presenter, Alan Plumley. Alan?
Thank you, Terry. Yes, it works. Right, so I'm going to be presenting some research that several of us have been doing concerning the extent of non-filing. This is joint work with my colleagues at the IRS, Tom Hertz, Pat Langeteeg and Mark Payne, and also our colleague Maggie Jones at the Census Bureau. Now, when I mention here individual income tax non-filing, I want to point out at the beginning that we include in that self-employment tax as well, because both the individual income tax and the self-employment tax are reported on a 1040, that is, if the 1040 is filed. So we estimate both together, and typically for our public releases, we separate the two. But I wanted to begin by defining what we mean by the extent of non-filing. And so we speak of the individual income tax and estate or self-employment tax gap, non-filing portion of the tax gap. And that's the amount of tax not paid on time by those who do not file a required tax return on time. So it's net of any tax that was paid on time by non-filers. And so that could be through withholding, estimated payments, maybe credits that they would have been eligible for, and so on. Now, some non-filers actually don't contribute to the non-filing gap because even though they might be required to file, they don't have a tax liability, or maybe they've paid it full on time. So I wanted to also kind of lay the groundwork here by defining our population. Non-filing is used in different ways. The term is used in different ways by different people in different contexts. I wanted to explain our context here. So if you start with the entire IRS population, and here throughout my presentation, I'm going to be looking at tax year 2010, because that's the year we have data for, and I'll explain that later. But if you look at every individual on a tax return or in a third-party information document that IRS receives, you'd come up with 241 million. Well, 190 million of those are timely filers. So we set them aside for the moment. And that leaves us with 51 million potential non-filers. Now we say potential because they may not have a filing requirement. And our estimates are that if you take out the ones who don't have a filing requirement, that is, their income is below the relevant thresholds, you knock off 32 million from that, leaving us with 19 million non-filing individuals. But we reduce that count a little bit more when we combine some of those individuals onto what would have been married joint returns had they filed. And that brings us down to 15 million returns representing those 19 million individuals. And we further observe that some of that 15 million population actually do file late. It's around 4 million, leaving us with around 11 million people who don't file a return. We affectionately call them not filers. So I mentioned a couple, or that there are filing thresholds defining whether or not someone needs to file a tax return. The most common one is the gross income threshold, which in 2010 included the standard deduction, any age or blind deductions that would be added to that, and of course, personal exemptions. Well, several of those things depend on the filing status. So whether they would have filed a single, married, joint, head of household, and so on. But the IRS doesn't know what filing status they would have been eligible for because they didn't file, or at least the not filers didn't. And so that's a problem. The second filing threshold has to do with net self-employment earnings. if someone has more than $433, they need to file a Schedule SE and file a 1040 to attach that schedule to. And here again, the IRS really doesn't have much, if any, hard data on the net self-employment earnings of most of these non-filers. So our main way of addressing these two challenges in using our own data has been to impute filing status to these potential non-filers. And to do that, we observe standard profiles from aggregate census data, and we take into account how much of that standard distribution of filing statuses is accounted for by the filed returns, and that guides us into an imputation for the non-filers. And the second problem we address by imputing net self-employment income to potential non-filers based on what we observe from filed returns that taxpayers report net self-employment income on. Now, of course, that makes takes the assumption that the non-filers have the same propensity to have self-employment income, but that's all we have at the moment. So if you combine all of this, you can apply the filing thresholds to identify non-filers in our population data. But we have this nagging question: how reliable is our filing status imputation? Because everything sort of hinges on that. The thresholds hinge on that. And so we have a second method. Imagine if you could actually know at the micro level what the filing status was of these potential non-filers. And we can actually do that by matching our IRS administrative data to sample data undertaken by the Census Bureau. And so IRS has made available comprehensive IRS data recently to the census so that we can conduct further tax research of this kind. And so the Census Bureau makes that possible by assigning to each of the records what they call a protected identification key, or a PIC. And so that's just a unique identifier which they apply to both the IRS records and the census records so that we can match these data sets anonymously for more accurate research. And so if you imagine the sample of respondents in a typical current population survey data set, as overlapping to some extent are administrative data showing a population of potential non-filers, and we'd be able to infer much from that overlap and weight up to the total population. However, we have a bit of a snag in that not all of the census data, or the IRS data for that matter, can be assigned a unique PIC, and so they can't be matched to the other data set. And so the census sample needs to be re-weighted. Now, we've chosen to weight up to the population of potential non-filers, not the typical CPS ASEC population, because we're sort of suspicious that non-filers may be more prevalent among the ones who could not be picked. And so we want to make sure that we're addressing well the nature of the non-filing population. Well, what we find is that we've got the potential for kind of the best of both worlds here. where we use the CPS ASEC, in this case, for the important demographics at the micro level. And we also use it a little bit for a source of income in the case of spouses who could not be picked. So their spouse was picked, they're in the sample, but here's a spouse we don't have any information on. We make use of what's reported to the census. Otherwise, we rely entirely on the IRS administrative data, all the third-party information documents, and so on, for our income for these non-filers or potential non-filers. And we impute net self-employment income in that environment as well. And that's also what we use to derive these new weights so that they represent the population well. So this paper actually is an update to a paper we presented at the NTA conference last November. And yet we make two rather significant innovations in this paper. First, we improve our imputation of self-employment income by controlling better for the age of the taxpayers we impute this income to. And then secondly, by training our model on per exam data from the IRS's National Research Program. So what we're doing there is we're saying, okay, we're going to impute to them not just what typical taxpayers report on their 1040, but we're going to impute to them what these audits suggest ought to have been reported on those 1040s. So it's a little bit more extensive here. Our second innovation is to include late filers, so that when we combine the not filer gap and the late filer portion of the gap, we arrive at a comprehensive estimate of the non-filing tax gap. Well, I thought it would be useful to see what we get. Now, these black bars indicate the incidence of various income types in our population data, our population of potential non-filers. And we find that if we restrict our analysis to just the information available on the CPS ASEC with a little bit of imputations, and we weight it up with the typical adjusted weights, we fall short of what we observe in our population data in terms of the counts. Well, if we rely on the comprehensive IRS data that I mentioned, and we match it here at the micro level, but still use the adjusted CPS weights, we do better, but we're still not quite all the way there to estimate what we actually observe in our population data. But if we do apply the new weights that we have specifically designed to get us here, we find that in fact, we are hitting our targets pretty well. So that's encouraging. You might ask, well, how does that influence estimates of the overall income of these potential non-filers? And we find likewise that pretty much no matter how you base the income assumptions and so on in your analysis, if you use the new IRS weights, you do get up to the income that we observe in our population data. So that's encouraging as well. We've shown here how the mix of various income types varies as a function of total income among the not filers. And we see that in the middle, it's kind of a stable mix of income types, but at the low end, there's a much larger role for self-employment income as a share of total income. And at the higher end, there's a greater role for things like investment income and the other income line item on the 1040. So all non-filers obviously are not created equal. All right, well, I mentioned that we are also including late filers here, but I need to explain that given the fact that we have only 1 year of data at the Census Bureau, 1 year of IRS administrative data that's comprehensive, we're limited to define our late filers as those who file after their filing deadline, but they file before December 31st, 2011, which is the last day of the data set that we have. So that's sort of early late filing. We would prefer to define it several years beyond that date, and we expect to eventually once we got more data. But for now, and what I'll show you now, it's late filing toward the end of that initial year. Now, that doesn't mean that we're leaving people out. It means that we're treating them as a not filer instead of a late filer, where we could actually make use of whatever information they reported on that late return. Okay, so when we do all of that, we see that the tax units that actually do have a filing requirement have a variety of income types, obviously, but we find that the late filers tend to have a greater representation of wages and interest than they do of these other income types. And that may be somewhat related to why they're filing late, or at least a little bit late.
Alan, I'm sorry to hop in, but we're moving on our time element.
Okay, I'm just about done.
All right.
Thank you. Bottom line, our tax cap estimate is 37.7 billion, coming from 14.9 million late filers. The late filers account for 25% of them, of the returns, but only 13.5% of the gap. There are a variety of things that we want to include in future analysis. A major thing would be taking into account multiple years, and we're on the threshold of doing that. So with that, I'll turn it over to the next presenter, Jan.
Thank you, Alan. So I'm going to be talking today about using uplift modeling to improve ACS case selection. And I just want to take the time to thank Travis Whitfield, Sarah Smolensky, Michael Stavrianos, and Lauren Zerbinski in ASR Analytics. They did a lot of work with our team, and a lot of the uplift modeling that I'll be talking about is highly contributed to their work that they put toward this. So I just want to go ahead and talk a little bit about, and I can't get, hold on, there we go. I want to talk about the background first on what exactly is ACS optimization. It's important to understand where taxpayers fall within that collection stream. And so I'm going to kind of set that stage so that you understand exactly where they're at within this process of the modeling that we've been working on. So a taxpayer will come into the IRS and they'll file a balance due tax return. And if they can't pay when they file that balance due, they receive at least 3 very nice notices that remind them that they owe within anywhere from 20 to 30 week span, reminding them, hey, you still owe us money. We really need to pay. Here are multiple options and choices that you have to resolve this issue with us. So by the time they've gone through all of that, if they still have not resolved the balance due, they move into what we call the ACS inventory. ACS is the automated collection system, which is basically where they start to go into the enforcement process of levies and liens, and where we start to get a little bit more serious about trying to get them to take what they owe the IRS in a notifying us to try and work with us so that we can help them resolve the issues that they have. So the ACS area is where we are sending out what they call LT11s and LT16 notices to the taxpayers. Those are those letters that say, hey, you have 30 days to resolve this issue, or we will be taking enforcement actions. For example, we'll be filing a levy. Levies can be filed against, for example, wages or banks, depending on what sources are available to us. So it's important to understand that these taxpayers have been given their legal notification and they have the right to appeal this process. So because of the resources that everybody in the service center, of course, are dealing with at this time, the ACS put together a team called the optimization team, and they wanted to take a look to say, how can we improve on our processes based on the resource constraints that we have? So they looked at two possible avenues. One is notice design. They wanted to improve on the notice designs to help taxpayers better understand what we're asking them to do, as well as case selection. How can we decide which taxpayer should receive the notices and be able to provide them good customer service based on the resources that we have to answer the phones. So the first process that we've already taken care of, and we've done a lot of work on the notice redesigns. We've redesigned the notices using behavioral insights. We've been able to reduce a lot of the 6-page notices down to 3-page, very easy step-by-step processes. Here are all the resources available to you. Here are some online resources. Here's where you can contact us. Basically, this is what you need to do. This is how you need to do it. And we're more than willing to work with you and hope that you contact us to resolve this issue. We ran pilots on all of these designs using what we call a randomized control trial. And as you can see, we not only addressed notice redesign in the ACS inventories where their LT11 and LT16s are a little bit not nicer notices, as I would call them. We also redesigned the earlier notices, which were the very first 3 notices a taxpayer would receive that are that more friendlier tone. It's like, hey, we understand you owe, and we really want you to try and resolve this. The next thing that the ACS optimization team wanted to look at, it was that case selection, right? So what is case selection? It's just that machine learning model, and they wanted that are implemented to identify which taxpayers should receive a notice. So in 2019, as part of the LT16 notice redesign process we decided to kind of take a look at a case selection methodology. And on this process, in this pilot and test that we ran, we did not use an uplift predictive. We just used a model, probably something similar to a linear regression, and tested the ability to say, if we send a taxpayer a specific notice or a specific group of taxpayers this notice, would they come in full pay on this account? So some of the lessons we learned from this pilot, especially the prevalence of refund offsets. So we did see that taxpayers we could predict that specific taxpayers would come in full pay on their accounts, but a huge percentage of those were due to them coming in and filing a refund tax return, which then offset that balance due. So we wanted to incorporate this understanding that we learned on this refund offset prediction for our uplift modeling efforts. So what exactly is uplift modeling, and why did we decide to look toward uplift modeling? Well, uplift modeling is an incremental change in the likelihood an individual will take a specified action or change in that magnitude of that action in response to a treatment. So what does that mean? Basically, the probability that a taxpayer will take an action after receiving the treatment, and the probability that the individual will take the action if there is no treatment, which means that T is a treatment status, which represents a binary indicator whether that taxpayer has received treatment, and then Y is the outcome of interest, where it's a binary indicator whether the taxpayer undertook specific actions. Now, we understand that estimating uplift is challenging, so there are some constraints, and it's challenging in part because a given individual cannot both receive a treatment and not receive a treatment. So it's not possible to directly measure uplift. So instead, uplift is typically measured in aggregate with the return, that randomized control treatments. So this is the way of underlying characteristics or behaviors of that individual in each group that will be compatible in our uplift modeling. So what does that mean? Basically, what we want to do is categorize taxpayers when we're doing uplift into basic category matrix. One is considered the sure thing, right? Taxpayers who will self-cure. They are the ones that will full pay regardless of whether they receive a notice. And this also includes those taxpayers that fall within that refund offset. Then you have your do not disturb taxpayers for whom a notice has a negative impact, right? The likelihood that they will pay. So this represents those taxpayers who will only call upon receipt of a notice. We have those that are persuadable, taxpayers who will full pay only if they receive a notice. And then we have the last group, which is we consider the lost cause. Those are those taxpayers who will not full pay regardless of notice receipt. This includes those taxpayers, by the way, who are not financially capable or unlikely to successfully receive the notice. So a lot of the undelivered inventory. So the goal is to identify taxpayers in the persuadable group and only send notices to those taxpayers. So much of the modeling effort is involved in identifying the sure things, the do not disturbs, the lost cause taxpayers in order to ensure they are not sent a notice. When it comes to uplift modeling, I just want to make it clear that there are multiple, what's a good way of putting this? There are a lot of different approaches to uplift modeling. And for some reason, I have lost control of my slide movement. Do we know why? Nick, do you know why I cannot gain access to my slides anymore, or why they're not progressing? Yep, there we go. Now we're moving. Thank you. So we understand that there are multiple ways of, there are a lot of uplift modeling approaches, but we specifically decided to look at three. One would be the two model approach, which are two separate models that are trained on treatments and non-treatment groups. And this predicted uplift is the difference between the prediction of the two models. There's the single model, which is one model is trained on combined data set or treatments and no treatment groups, where treatment status is a feature in the model. So a predicted uplift is the difference between the prediction of the model when t equals 1 and when t equals 0. Again, so write that treatment of one doing taxpayer does receive a treatment or taxpayer does not receive the treatment. And then the third one was the class transformation. The new target variable z is created such that z equals 1 when t equals 1 and y equals 1, and when t equals 0, y equals 0, and z equals otherwise. So this is a single model is trained to predict the new target variable when predicted uplift is calculated. So again, z is just a single classification estimator. And again, z is also determined by y if the treatment is what the treatment status, or t equals associated with the observation. So those are the models that we use toward uplifting approach. And again.
On the slide, Jan.
What?
Have you tried just clicking?
Yes, I'm trying clicking, I'm trying everything, and it just doesn't want to cooperate with me for some reason.
I can advance for you then if you just say next slide.
Next slide, please. So because a single taxpayer can't both receive a notice and not receive a notice, an uplift model must be evaluated in aggregate to its performance. Uplift models are evaluated by plotting the normalized cumulative uplift versus the normalized cumulative individuals treated. So the area under this curve, which is the uplift AUC, can be used as a single metric to compare different models corresponding to the same data set. The uplift AUC can be normalized by dividing it by the area under the perfect model curve, which is the example that we show on the uplift chart. Next slide, please. So taking into account the lessons we learned from that prior LT60 model test, an enhanced uplift modeling approach was developed. So this approach involved three main components. One was a refund offset model to predict whether a taxpayer is likely to have a refund offset applied to their account. Two, an uplift model to predict the uplift in dollars collected upon receipt of a notice. And three, an uplift model to predict the uplift in incoming phone calls upon receipt of notice. So as you can see, a part of the experimental or exploratory analysis that we did, we took data for those taxpayers in the ACS inventory, right? So again, they have already moved into this enforcement collection inventory. And we analyzed the data or the behaviors within a 365-day period after they move into ACS. And we looked back from 2016 clear to 2018. We did not incorporate 2019 data because again, COVID kind of put an if quality as to whether or not the data would be available to really do a good experiment on. So as you can see, approximately 35% of the taxpayers in ACS file a tax return with a refund within 1 year of entry, and about 10% file a refund large enough to result in the full payment of their balance due. So successfully predicting which taxpayers will fall into that 10% would greatly improve case selection and allow the IRS to focus limited resources on other taxpayers who are more likely to benefit from receiving an LT notice. Next slide, please. So again, another offset model result is the resulting full payment refund offset prediction model was highly effective. Now, what exactly does that mean? When you're training a year of 2015 and testing a year of 2016, this model achieved the NROC AUC score of 0.8 and an accuracy score of 0.886. So basically, anytime these scores remained the same in subsequent models, regardless of which years were used for the training data when predicting 1 year into the future. Go ahead and turn the slide because I know we're running short on time, so I just want to quickly run through some of the others. We wanted to take an opportunity to say, you know, where within the account balances and the historical data. So an expected total account balance and historical tax refund balance due amounts were the features with the highlights predictive power. Go ahead and turn the page to the next slide. So to predict the total dollars a taxpayer will pay within a 365-day period receive an LT notice, we wanted to determine if we sent them an LT notice within 365-day period, what would be the results in our experimental tests based on this data. And as you can see, the results show the large improvement in dollars collected that can be achieved by sending notices to a fraction of the total eligible recipients. Turn the page. We can also show that many of the features of the total dollars collected in these models are the same as those for the refund offset model, which of course is indicating that the refund offset plays an important part in this modeling process. Next slide. It's also key to note that we're not just looking in our uplift modeling results or in our uplift modeling experimenting testing on the data that we have on just whether or not taxpayers will come in and full pay, but we're also looking at phone calls. So if we were to send a taxpayer an LT11 notice, would they call into the IRS? So as you can see, there appears to be less predictive power in the LT phone call model than in the LT total dollars collected model. But the results do indicate that the model can help identify which taxpayers are more likely to call the IRS after receiving their LT notice. All right, final slide. So in conclusion, uplift modeling is a promising approach to optimizing ACS case selection processes. And we will be conducting a pilot test to evaluate this methodology in the coming months. Also, it's important to note that the refund offset model is a promising approach to identifying taxpayers who are likely to self-cure. This model can be done without the need for a dedicated return control, randomized control trial, which expands the possible applications where this sort of approach can be taken. So sorry that was really fast, but modeling is a lot to discuss. So thank you guys very much for listening. And at this time, I will go ahead and turn it over to our next presenter.
Thank you. So my name is Getane Yisma. This is a joint work with my colleagues, Drew Jones, Takir Hussain, Jonathan Krim, and our group chief, Mary Helen Riesler. What I'm about to present is our opinion, the author's opinion, and not necessarily IRS or that of the Treasury Department. So a brief outline of what I'll be talking. I'll introduce the context in which DIF is used, some background, and just a brief methodology, and then a difference between DIF and the standard linear discriminant analysis, and then some of the do's and don'ts on using a DIF score, and then some of the criteria that we use to select models and how we evaluate. And then the model improvements, model developments that we have conducted in the recent past. And then results of those models that we put in place. And I will briefly also mention what alternative methods that we're exploring and some of the future works. On the enforcement side, IRS have a lot of tools. Examination is just one tool. And for examination, IRS has a lot of methods and sources and strategies to select. One of them is compliance risk models, especially for returns where we don't have accurate and complete third-party information. Compliance risk models are the way to select returns. And DIF is just one among several risk models that are out there. And there are DIF models for C Corps, partnerships, and flow-throughs or 1120Ss. And individuals, but today I will be focusing on just individuals. As probably most of you know, DIF has been around for a while. It is a supervised machine learning technique, and it is trained or it is developed using a statistically representative returns, such as the currently what we have from the National Research Program or previously from the TCMP. And DIF is one of the main tools for return selection. So in general, the misreporting distribution is highly skewed. A lot of returns with no or little tax change, and few of them with significant or high tax change or misreporting levels. And so ideally, we would like to select returns from this high tax change region in the orange region. And so we, based on data from NRP, we set this high tax change threshold. And so the idea or the objective for DIF is to be able to predict returns that fall or that are likely to fall in this high tax change region. And so basically the model or the objective of DIF is to come up with predictive models that is likely that higher DIF scores are likely to fall in this orange region. So even though DIF is the mechanics of estimating the parameters or the coefficients of the models is the same as the standard linear discriminant analysis or LDA, DIF is a modified application of LDA. And there are significant differences, and that is on the returns or the variables are changed into discrete likelihood ratios. And that has made DIF more robust and effective throughout these years. And some of the do's and don'ts of DIF is that DIF is developed for each activity code separately. So activity codes are basically a class of returns, class of returns that are as homogeneous as possible within a class, but as different as possible between activity codes. So for individuals, we have about 12 activity codes. Next year in 2022, we will have 14 activity codes. And so we have DIF models, separate DIF models for each activity code. And return compliance level is different across activity codes. And therefore, you cannot compare DIF scores across activity codes. Unlike credit scores, you cannot compare DIF scores across activity codes. And the most important thing in how to use DIF may not necessarily be the score, just the nominal score itself, but the important thing is the rank of the return, the rank of DIF. So some of the three criteria that we use to evaluate and select models are average tax change. So that's just the overall tax change dollar amount, and then the no change rate. No change rate is basically returns that fall into this green line. So there is a no change threshold. When we develop models, we don't want to we want the model to we want to differentiate models that have, say, $0 versus a very positive a small positive dollar amount, and then the high tax change is basically the hit rate. So one example, for example, that this is from model development is, so this is average tax change, and this is the high tax change. The middle one is the high tax change or the hit rate, and the third one is the no change level. So in this case, the green one is the perfect selection, and the orange one is the new model, and the darker one is the existing model. So in this case, as you can see, the new model is much better than the existing model across all three classes. Less no change rate than the existing model and so on. So we compute these things cumulatively. So let's say if we were to audit 1% or 0.5%, what would be the average tax change? What would be the no change rate? What would be the high tax change rate and so on? And we go across this, say, up to 20%, 15 or 30%. And then we look at different models and we select. So in this case, for example, the new model definitely is doing better than the existing one, we'll implement it. But there are cases where we may have a model doing better on dollars, but not on average tax, on no change rate. In this case, we may redevelop test and so on, or depending on how it does, we may not implement the new model. So how good is diff, for example? One way to compare it is, what if we don't have a risk model? In that case, we have NRP. From NRP, we can estimate the level of misreporting or the average tax change by activity codes. And we have the weighted average is a population estimate. So these are the greens, and the orange ones are the primary diff select average tax changes, recommended tax changes for selected activity codes. As you can see, it's for the same year, returns filed in 2016. As you can see, diff definitely performs better than the random selection. So beginning in 2006, tax year 2006, the National Research Program changed the sampling design from one of like large, 40,000, 50,000 samples to a small annual continuous yearly sample design, rolling sample design. And so that meant that we're getting annual data, but not in sufficient numbers. So that required us to accumulate data to be able to use develop models. So the first time we thought we have data to develop model was back in 2011, 2012 for filing year 2013 implementation. So on that year, we have a 3-year data, and we identified 5 activity codes, and we implemented 2 of them. And then next year, we added one more year data. We identified 5 classes, some of them the one that we already modeled last year, and we implemented 4 of them. Then 2 years later, with 5-year data, we developed 7 models, and we implemented 6 of them. And in 2019, we developed 6, and we implemented 5. So by this time, all individual diff models for all 12 activity codes have been implemented. Of these, 5 of them have been updated twice. And next year, we have 6 classes that we are working with IT to implement. So some of the, I'll preview some of the results. So these graphs for the 5 classes that I mentioned that we developed twice, we updated twice, and we selected, we pulled data from Audit Information Management Systems, AIMS closed from 2010 to 2016 to show the trend before and after. So the first one is the activity code 73. So 273 is, they are not business returns, but they will have either Schedule E, which is rental income, other supplemental incomes like that, or Form 2106, which is the unreimbursed employee business expense, or both of them. They could have both. And the total positive income for this is under 200,000. And so as you can see, the green one is the prior model, which was developed using NRP 2001 data. And it was, this was the trend line, and we implemented in 2013, as I mentioned earlier, and dollars increased by about 60% above a trend line. and the second update more stabilized with the additional NRP data here. And more importantly, here is the average tax change. I mean, the no change rate. The second one is the no change rate was about 18-20% prior to the new model, the old model based on NRP 2001 data, and no change rate went down from about 18-20% to 5%. So that's a significant reduction of from 1 to 5 no change cases to less than 1 and 20. Second one is the activity code 274. These are the smallest Schedule C classes where the total gross receipt is under 25,000. Here, as you can see, the no change rate is in single digits for that model. It was one of the strongest. The prior model is one of the strongest. We made incremental progress on that. This one is the activity code 279. 279 is non-business, but as like 273, they may have Schedule E or Form 2106. These are more higher than the 273. The total positive income for this class is between 200,000, but under $1 million. So for these classes, as you can see, the average tax change was trending down or just about flat. And the year that we implemented the model, the average tax change doubled. And no change rate essentially it ticked up a little bit, but not much. It was almost flat. It remains like that for the last 3 years that we looked. This is a business class, Schedule C class, where total gross receipt, the total positive income is, it's like 279 between 200,000 but under $1 million. And they have to have a Schedule C for these returns. And as you can see, the dollars were flat, about 20,000. And the new model basically went up by about 55%. No change rate remained stable. And lastly, this is the large, the million and up total positive income. These returns could be complex. Dollars were about flat or going down a little bit. And the year that we updated the model, the average tax change doubled and it kept increasing. Now, by the second update, it was 3 times what it was before we updated the model. And more importantly, also the no change rate went down from about 50% to 40%, and it remained there. Okay, so as we update DIF and we look at what we can do with additional NRP data, we also look into alternative methodologies. Prior, just to mention the prior researches, a little bit, say the last 10, 20 years, there have been always research to look into latest methodologies and alternative methods to see if either we can enhance DIF or come up with something better. So various 2-stage models, some kind of classification probability on the first stage, and then some kind of regression, and then we combine the two to have a predicted expected value of tax change. So we have several both outside contractors and inside to look into this kind of models. And also the early versions of neural networks and regression and classification trees have been also attempted. Recently, as probably most of you know, analytics and data is IRS's strategic goal. And there are a lot of efforts on model development and so on. And so just to mention two of them that we participated in, one is we just recently concluded a contract with a private outside research data analytics firm to come up with, to use machine learning algorithms to come up with predictive models for two classes, for two activity codes. And they used parametric classification methods to come up with models, and we evaluated, we took the best 6 models and we evaluated, compared them with the current diff and tested using independent test data. That means data that was not used by contractors or by diff to develop. And so the result is that they have a better, slightly better no change rate, but diff maintains better high on dollars. We'll continue to update diff as we get data, and also we will continue looking into alternative techniques and to see what can be done either jointly or in some form to enhance return selection. That's it. And with that, I turn it to Brian Gerard, who is our discussant.
Well, hi there. So thanks so much for having me to discuss these 3 excellent presentations. I guess the common theme across these papers is trying to make the best possible use of available data to both assess and address compliance issues. I want to start with the study that Alan presented. It's truly a remarkable achievement that the IRS was able to conclude an arrangement with Census so that very detailed administrative data could be combined with the CPS-ASEC data. The results so far really do help to clarify the potential nature and size of the non-filer population. Ongoing work, I think, promises to bring further insights. A concern that's raised by this study is the data quality of the income information on CPS-ASEC, which is relied for so many research studies and for poverty estimates and a variety of other purposes. Maybe this is the beginning of a trend that will continue where surveys like this rely more on real tax data where it's available to improve on just asking people how much income they've made. So this approach relies on administrative definition of potential non-filers, namely folks who don't have third-party information returns or haven't filed a return. And I'm sorry, it's folks who have third-party information about them who haven't filed a return. And you know, it's important to ask the question, well, who might that exclude? You know, it's probably not a comprehensive definition of the non-filer population. Well, some folks don't have interest-bearing bank accounts or other income sources that are reported on these returns. That might include some undocumented immigrants, folks who are paid under the table, various gig workers or other self-employed workers. Also, of course, there's the issue of folks who provide inaccurate TIN information to their employers and other parties. And so it's not getting us all the way there, but it's, you know, captures a good bit of the population at least. Now, this data is matched against the CPS-ASEC data, and that latter data source is relied on primarily for demographic information, such as marital status and children. It's important to ask, well, if you're matching against that, how complete is that data source? And the census has done a lot of research over time. And what it's found is, well, there are folks who are hard to locate, hard to contact, or hard to persuade to participate in their survey. And while they bend over backwards trying to get these folks to participate, they no doubt aren't always successful. And that includes a lot of folks who probably fall into the potential non-filer camp. And so it's useful to think about a little matrix here. The CPS ASEC data, folks might not be present at all. They might be missing. They might be there, but there's no pick, and so you can't match them. Or they're present and they have a pick. On the IRS data side, they might not be present in the data at all. They might not have third-party information. They might be present but excluded, for example, because their TIN information on those returns is bad, or the information itself is bad on the third-party return. Or they might be present and included. And so really what I see the study as being about is trying to use that box in the right lower hand corner, box I, to represent the last row at least, which encompasses the folks who are missing in the CPS, either because they can't be matched or they didn't participate in the survey, so that we get a picture at least of the folks who are in the administrative population as potential non-filers. So an interesting question is, well, how many folks really are left out by this administrative definition? And that's a hard question to answer, but there's a couple things one can do to at least get some sense of the problem, I think. One is look at the filers and see how many don't have third-party information returns associated with them. That gives you kind of a lower bound on the scope of this problem, because filers are probably much more likely to have third-party data. You might also look at how many CPS ASEC individuals exclusively report income on the survey from sources unlikely to be reported by a third party. And that might give you another idea of, is this a big number or a small number that are missing from this definition? So, as I said, the name of the game is to try to make that one box representative of a whole row. And the question is how well are they able to do that? Well, they use a very sensible weighting methodology where they divide by the probability that someone in the administrative sample would have a pick matched against them. And they control for things they can control for with their administrative data. The one issue I'll point out is the census has looked at this issue of who's missing a pick. And it tends to be folks who are minorities, residents of group quarters, immigrants, recent movers, low-income individuals, non-employed individuals, and the like. Well, a lot of these factors can't really be controlled for in their analysis. And so there's some question, are they getting the weighting right? Are they once they weight that group I, is it truly fully representative of groups G, H, and I at least? And probably not perfectly, but it certainly gets us closer to the case that we want to be at. Oh, what happened? I hit a bad button here. How do I get back, guys? Oh,
Which way are you trying to go?
can you do it and I'll let go?
Oh.
Thank you.
Can you tell me which slide you're on?
Well, why don't you go 4 or 5 and I'll get us there. I can fine tune. Sorry about that. I hit the wrong button.
All right, just 1 second.
I broke my presentation. That's a little too far. Okay, I'll back us up.
So go back.
Yeah, I'm gonna need to go back. We're a previous, yeah, a little further. We got to get back to we still got to go back. Yeah. Okay. Oh, stop. Okay. Thank you.
Okay, and I'm going to give you control again.
I appreciate it.
you click the slide.
Well, I tried click. You want me to click the slide or you want me not to click the
You
slide?
go ahead and click.
There we go.
Okay.
Okay. So as I said, the reweighting probably not perfect, but pretty good. The good thing about this study is that for things subject to third-party information reporting like wages and interest, they can measure it quite well. They're using self-employment income to impute non-filers. I'm sorry, their filer self-employment income to impute non-filer self-employment income. Not ideal, but understandable. They might replace the mean prediction they're putting in with a randomized draw that might get a little better distribution in their sample. They might also think about imputing other sources not routinely reported on third-party information returns. One thing I want to say before I move on to this slide is that they find that high-income non-filers account for a large share of the tax gap. I think that really needs to be validated to make sure that they're really computing tax properly, that they aren't missing some issues that make that number smaller. It also might be that those are very late filers that aren't captured as late filers in their analysis. So I think that really needs to be explored, maybe looking at some of the non-filer enforcement on high-income taxpayers that's been going on recently. Now let's talk about Jan's presentation. A very nice study, careful modeling process. They thought a lot about the target variable and the time window for allowing for a response, which are important issues. They had a rigorous process for training, tuning, and testing the data and for scoring alternative models. They explicitly took into account the resource constraint on the number of calls that could be made. And they evaluate success based on uplift, not just on whether a person complies after receiving a notice. So all good things. The lesson from this is taxpayers are heterogeneous. They differ in terms of how they'll respond to a treatment, how much revenue they generate as a result of their response, the burden they experience, and the resource costs that are imposed on IRS through the treatment. So one wants to apply the right treatment to the right taxpayer, including perhaps not treating some taxpayers at all. That's especially important since the IRS is so budget constrained. It just doesn't have the resources to treat all taxpayers. And frankly, it shouldn't treat them all, even if it did. Consequently, from a cost efficiency perspective, what they're talking about seems to make sense. Prioritize taxpayers where the bang for the buck is the greatest, and allocate resources across these different programs according to where they're the most productive on the margin. Now, we saw a diagram like this in the presentation. We had the groups of sure things, do not disturbs, persuadables, and lost causes. And Jan gave us a tentative answer in terms of who we ought to focus on in terms of the most likely to produce good results. And from a cost effectiveness perspective, we're told we should avoid the do not disturb taxpayers. That makes sense because the treatment seemed to backfire on them. Avoid the sure thing taxpayers, and this includes not only folks who are gonna self-cure by complying anyhow, but folks who might get caught up in another program such as refund offset, and so you don't really need to treat them. We're told we should seek out persuadable taxpayers, especially if they contribute a lot of revenue relative to the resource cost of treatment, but we should probably avoid persuadable taxpayers who are experiencing financial hardship or for other reasons, it's really not in their interest to comply. We should probably avoid contacting them. What about the lost cause taxpayers? What's the story with them? Well, Jan kind of suggested we should leave them alone. After all, they sound like lost causes. However, some compliance treatments, including the LT11 program, do give the IRS legal authority to take certain further compliance actions if a taxpayer doesn't respond to a notice or other treatment. And so examples, the LT11, a substitute for return that they receive, or a CP2000 letter. If taxpayers don't respond, the IRS gets an authority to take further action against that taxpayer. And so I would argue that in some cases it does make sense to apply such treatments to those taxpayers, even if they're not going to voluntarily comply by making a payment, say. It gives you a chance to actually impose a lien or garnish wages. So another issue is, are there concerns beyond cost effectiveness? You know, some would question whether it's fair to avoid treating certain non-compliant taxpayers just because they're somewhat more costly to treat. And I suppose it's possible in some scenarios where you might have unintended consequences from a strict cost efficiency approach. For example, taxpayers may see an incentive to become difficult to treat just so the IRS won't treat them. Let's talk about the DIF study. When it was first introduced, the DIF program was way ahead of its time. First, it relied on a large-scale random audit program, which is still rather novel. It also carefully looked into segmenting the overall population into relatively homogeneous groups and tailoring models to each of those groups. They also looked at, you know, how many groups should they have of compliance outcomes, and should they do things like include refund cases along with no change cases? They gave careful consideration to those issues. They also constructed these variables that Gaetana told us about involving binning and likelihood ratio. Well, that's been used a lot in credit scoring since the DIF was developed quite successfully. They also had a systematic variable selection algorithm. And they even looked into refining their model by first estimating it in scoring returns, then dropping the easy to score cases that don't predict much, and then refining their model by estimating again. A lot of these ideas are foundational in modern data analytics. And so they really built a pretty nice framework here. And it has, in a lot of ways, stood the test of time. In fact, many of the features of the process today are more or less the same as they were back then, though there have been some refinements. One improvement is that when they look at alternative models or refining their models, they now tend to evaluate based on out-of-sample performance, which is really important given the DIF binning approach, which kind of stacks the deck in favor of their method if you look at in-sample results. However, some of the model evaluation approaches discussed in the paper I didn't think were ideal. One was comparing DIF against random audits. Well, believe it or not, I have found examples of programs that are sort of audit selection like where they haven't done better than random. You know, for the most part, this is like shooting fish in a barrel. It's pretty easy to come up with a method that's better than random. So I think we can do better in terms of, you know, showing how good DIF is. Also, the trend line analysis that we were shown is suggestive but not definitive. After all, audit coverage rates have changed over time, which would affect the compliance levels you see. And the compliance behavior might change over time. With regard to updating models, it'd be interesting to explore updating them, you know, on an annual basis using a combination of new NRP results and some earlier NRP studies, and to automate the process a little bit so that you've got more frequent updates using the freshest possible data. One thing that might be worth thinking about is taking these kind of legacy activity codes and thinking about whether really that's the best way to segment the data for analysis of this sort, or maybe there's better ways to do it using some analytic techniques. Finally, this is the last slide. With regard to modifying or replacing the DIF method, I'd encourage the IRS to use that contractor study. They've got more information than the contractors did when they were doing the study. They could refine some of those approaches and see if they actually can build a model that, you know, competes favorably with DIF. That would be a worthwhile exercise, I think. I also think they need to be more explicit about how much weight they put on these 3 different performance metrics. It's really not ideal to try to, after the fact, judge how much you really care about one metric versus another. You should think about that in advance and use that to evaluate your models after the fact. Finally, it seems that with the changes in the NRP design, which is more heavily tilted toward refundable credits and less sampling of core tax issues, that they may indeed need to try some alternatives to the current DIF approach, perhaps relying more heavily on operational data as well as random data. Thanks so much.
Thank you, Brian. And thank you to our presenters for their presentations. Now, we will give our presenters an opportunity to respond to our discussants' comments. We'll start with Alan and then Jan and Gatana. After that, we'll cover questions from our Q&A session. So, Alan?
Yeah, thank you very much, Brian. You obviously, from your experience, have great insights here, and we appreciate those. We do have, as I didn't have enough time on my last slide to dwell on it, but one of our active areas for ongoing research is to get at this question of can we do a better job of including people who we're currently excluding? And there are dimensions there on both the IRS side and on the census side. And so that's an active area for research for us. I like your suggestions on at least bounding the extent of that problem by looking at the filers. We'll definitely do that. You mentioned it's a good suggestion to add some variation around the mean of the self-employment imputation. Turns out we do that, and we probably did you a disservice by not describing it fully in the paper. And so you're pointing that out reveals that as something we need to be more explicit about in the paper. But other than that, I really appreciate the input, and gives us good food for thought.
So Brian, thanks for the comments. You know, I always love to hear what you have to say. I just want to touch on a couple of things. One, on your concerns beyond that cost effectiveness. Again, you know, that kind of gets to that heart of that question of people who can't pay versus people who won't pay. And again, that's one of the questions that we're constantly throwing around. I also wanted to touch on the lost causes. On the lost causes, in the sense that those taxpayers, if you send them a notice, and this is notice stream for uplift, right? We know that we're not going to get any response. And a lot of it is, one, because we don't have an effective way to really do an enforcement on them, or they're truly undelivered taxpayers. They're not receiving the notice. But one thing that we are investigating in this uplift modeling is, by able to identify those that fall in that undelivered or another ways, we're able to use that modeling to step outside of notice stream and find an alternative way, right? Thinking outside the box of trying to locate them, get ways to get them to respond outside of that notice stream. So again, it's not like we're just going to put them in a little box and say we never want to touch them. It's we're using this uplift modeling to find another approach outside of the notice stream to utilize our resources to try and find them, but in another stream process. So I just wanted to point that out. And again, thank you, Brian. I do appreciate your feedback.
Thank you, Brian, for those excellent comments. So I think one of the comments that you mentioned was that the trend lines are suggestive but not conclusive. That's correct. We just showed what the trend line looks like versus you know, what the old prior model looks like versus, you know, when the new model was implemented. But in any way, it is not a causal study. We're not claiming that it is because of only diff that you know, dollars all of a sudden doubled. But we think, given that the trends, updated diff models greatly contributed to that, but it's not a causal study. As you mentioned, the activity codes have been in place for a while now. I think they were the current ones were in place back in filing year 2007. They are really doing good, but as you mentioned, it is a good comment that you know, from time to time those need to be looked at. As to the alternative methods, as I mentioned, we are constantly looking ways to improve, to see if we can either complement or supplement or in conjunction with DIF or separately to get a better models. And I think that will continue. And as you know, the operational data, it has, we have ample operational data, but it has its own drawbacks, but it is available. And that ways of using operational data will, I think, continue to be a research interest. And if there are any other questions, I will answer. Thank you very much.
Okay, thank you. We'll turn to our Q&A. Okay, let's see. First question. Yes, why? Let's see. This, I believe, is for you, Alan. In the SOI cross-section, several hundred taxpayers filed 2012 returns, then filed another regular 1040 in 2013 that covered the same time period. Sometimes income and or tax was higher or lower, and in some cases the change was between active and passive income. This was triggered by the tax law change in 2013. These were regular 1040s rather than 1040X, and both returns were in the SOI sample. The implications for this paper is that you need to check regular 1040s as well as 1040X. And that was their question, Alan.
Yeah.
Or statement.
I'm thinking, though, that wasn't a question for me because it had to do with SOI data and filers, neither of which I'm doing. So it may have been actually for Chloe's paper in the previous session dealing with amended returns in the SOI data.
Okay. All right, moving on. This is for the DIF model. What is the test data mentioned in the new DIF model?
Okay, good question. So when the results that we presented are actual closed cases, but for model development, what we do is we combine, say, 4 or 5 year data or 3 year data, depending on what we do. And we try to split randomly and withhold a test data, independent test data. And that's how current models that are in place, that's how they were developed.
Terry, if you're reading, I think you're on mute.
Sorry. DIF paper. You characterize findings by average tax change and no change cases. How do you classify exams that result in refund to taxpayers?
Excellent question. So all the results that I presented here, they are the positive recommended tax changes. That means the T37 amount for those who are familiar with IRS data. So the negatives or the refunds are considered 0 for this purpose. But we have looked at just the negative, the refund as well. And if you look at it, only one class or the rest of them basically are almost the same. There is no really difference between the refund, if you include the refund versus not, except one class, which is 281. And even that basically get the same trend, the same shape. But all that we have seen here is the positive tax change amounts.
Okay. Next question. Seems like DIF trends to focus audits on returns where IRS is likely to find the most non-compliance. Can the IRS be confident that this is where most of the non-compliance is, or are there perhaps many skillful evaders who are not identified effectively by DIF? If so, DIF may be more effective at collecting from the low-hanging fruit and less effective in improving voluntary compliance.
So not all sources of non-compliance will be captured by DIF, that's for sure, and that's why the DIF is just one part, and the service has a lot of methodologies, like for example, the SIP targeted identified known compliance risk issues are audited separately. DIF is just an overall risk measure, and if there are like known compliance risk issues and areas, and those are, I think, covered by separate programs. So DIF is not, they may identify them, but not to the extent that, for example, a different particular unique program may, for example, identify. That's true. And that's why DIF is just one part among the overall frame of compliance strategy.
Thank you. We've completed our Q&A, but Alan, I did have a question or an observation. If in regards to the re-weighting in the process, is it conceivable then that you would be able to run both series? In as far as one series tends to show a great capacity for the aggregate values, while the more detail equally hits at the aggregate values, but give more information for detail potential analysis. Is there an opportunity for running both series?
You mean both the administrative and the census-based? Yes, we do both. Both to check our totals, but we have great interest in the micro analysis that's possible with the linkage to census, because there are a lot of questions you can't answer with aggregate estimates.
Right. Okay. As another question, since we have just a few more minutes.
Actually, I don't think we do have more time.
All right. Then I will turn it over to Christine Orlet.
Hi. Can people hear me okay? Okay. So welcome to session 4 on the subject of enhancing taxpayer customer experience. I'm Christine Ohlert I'm a mathematical statistician in the IRS Office of Research, Applied Analytics and Statistics. I'm going to be hearing from 3 presenters. Anne Herlash is a senior analyst from the IRS Office of Research, Applied Analytics and Statistics, going to be speaking on increasing take-up of the American Opportunity Tax Credit. And Kahoa Bonhomme is from IRS Small Business Self-Employed Research, where he's a technical advisor, speaking on customer experience for small business and self-employed taxpayers. Janssen is again from IRS Research, Applied Analytics and Statistics, a senior analyst, and will be speaking on the question of annual federal employment tax returns. And so, Anne, take it away.
All right. Hello, everyone. Thank you, Christine, for that introduction. I'm excited to share some preliminary results from our randomized control trial focused on increasing take-up of the American Opportunity Tax Credit. I would like to start by thanking my co-authors, Mary Claire Turner, who is a behavioral scientist with GSA's Office of Evaluation Sciences, and Crystal Hall, who is an associate professor with the Evans School of Public Policy and Governance at the University of Washington, and an academic affiliate with OES. I'd also like to state the usual disclaimer that what I'm about to present reflects the opinions of myself and my co-authors and does not necessarily reflect the views of the Internal Revenue Service, General Services Administration, or the university we partnered with for this project. All right, first, a bit of background about the American Opportunity Tax Credit. So this is the most generous higher education tax credit. It was introduced in 2009 and was originally intended for tax years 2009 and 2010, but was later extended beyond that. It provides a maximum of $2,500 per student per year for the first 4 years of higher education. And up to 40% of that, or $1,000, can be refundable if the tax liability is brought to zero. AOTC replaced the Hope Credit, which had only covered the first 2 years of higher education. It also increased the amount and expanded what was considered an eligible expense. The rate of claiming AOTC isn't as high as you might expect, especially among independent students. Prior estimates have suggested around a 50% take-up rate among those eligible. So we definitely have some room to work with there. Some barriers to take-up include general awareness, and that is probably the most studied aspect of AOTC. But certainly complexity and confusion around eligibility is also a concern. So anecdotally, confusion can stem from the source of tuition payment. For example, students have mentioned being unaware that tuition paid for by student loans is actually an eligible expense. On the other hand, tuition paid out of a 529 savings account is not eligible. On top of that, well, some expenses paid for by that kind of savings account expenses paid by that kind of savings account are not eligible, a student might have other expenses which are eligible. So definitely some different nuance there, some different factors that could be confusing for students either as a dependent or as a primary filer. Furthermore, the coordination between dependent students and their primary filer can also create some challenges in claiming AOTC. Finally, on my list, which is certainly not exhaustive, is timing. So when you think about the differences in the calendar year and the tax year and when the filing season occurs, and then you layer on the academic year, which in a standard semester format starts in one tax year and finishes in another, it can be a little tricky to connect the timing and claiming the credit. Then thinking back to eligibility, let's say an eligible student is planning on graduating in 4 years, and they are interested in claiming AOTC. They'll have 4 academic years, but those academic years will span 5 tax years. So they'll have to make a decision on when to claim, primarily between that first semester, that first fall semester, and their final spring semester. So just again, to emphasize that it can be a little tricky to connect these things in a coherent way. So in this study, we sought to promote take-up of AOTC among students likely to be eligible through a coordinated communication bundle. And that bundle was designed with these barriers in mind. I want to note here that this study was a deeply collaborative effort with the Office of Evaluation Sciences and our university partner. So together, we were able to do some pretty extensive behavioral mapping around claiming the credit, including thinking through the different steps that were involved for different actors, from the university processes and the timing of things to actions students would need to take, depending on whether they were a primary filer or if somebody else was claiming them, and then what the primary filer would need to do to claim as the dependent student. And I can tell you, we spent a decent amount of time holed up in a conference room trying to draw out all of these different things on a whiteboard, which was really a great exercise to get a concrete view of our own understanding, where we potentially had some gaps in our knowledge about some of these factors at play for the different actors involved, and where we needed to do some more digging. So we then would like take pictures of the whiteboard and translate those into color-coded flowcharts on our computers that we could easily reference when designing the communications, and those served as a nice resource later on as well. But all of that is just to emphasize that we really tried to think through the different steps and barriers that might be at play throughout these processes. And it kind of emphasizes that if you think about like a credit like AOTC, where there's a possibility of getting $2,500 towards your taxes, potential to get $1,000 back, why would anybody leave that on the table if they were eligible? But there truly are a lot of different things at play here. So with those barriers in mind, and drawing upon the expertise and resources at OES, the university, as well as the IRS, we put together a 6-part communication bundle that you can see broken out in the timeline on the right. So that included 5 emails and a letter. And those pieces of outreach were layered on top of the business as usual communication, which is an email notifying students that their 1098-T is ready and available for download. And that's what the control group received. So they got that notification email, but not any other elements from the communication bundle. All of the emails were sent by the University Financial Services Office. And then we varied the sender of the letter to either be the University Financial Services Office or the IRS. So that was kind of an embedded, smaller exploratory test looking at messenger effects. And as you can see in this timeline, the emails started in November of 2019. So part of the intention there was to raise awareness of AOTC early on, try to help students consider the credit as they were making decisions about spring enrollment. We also wanted to get that first piece of information out prior to the winter break. We don't necessarily think that students were eager to go home and discuss taxes over a holiday meal with their parents. We wanted to try to increase the salience of AOTC going into the winter break to capitalize on the opportunity for students to connect with their primary tax filer when they otherwise might not have those regular interactions, say if they were living in a dorm. The rest of the communications took place over the course of the spring semester and into the summer. So originally, this was slated to end just prior to the typical April 15th deadline with a filing reminder. But this fielded last year during the onset of the COVID-19 pandemic. And obviously the filing season was extended, as well as some changes at the university. So we added a final email just prior to the updated July deadline. And I don't want to go through all of the pieces of communication, but to just briefly highlight some of the features. You can see on the left a screenshot of the IRS letter. So it's pretty streamlined, kept to one page, includes some specific steps for checking your eligibility and for claiming the credit. Half of the people in the treatment group received this letter, and then the other half received the letter with the same content. It just was from a different sender. So the branding was different, the logo was different. It had the University Financial Services information across the top, and that sort of thing. And then on the right, you can see an example of one of the emails. This is a generic one, just addressed to hello student. The actual emails were addressed to the students by name. These were certainly more visual in nature than the letter communication was, and they included embedded links. So we went through a lot of steps to make sure that these appeared right to the recipients. We looked at them on different operating systems and different devices, just to ensure that the recipient would be able to receive the message as it was intended, regardless of the device they were using. Each of the emails had a slightly different focus, so they weren't just receiving the same email over and over. For example, the second email was a reminder to download their 1098-T, and that included a note to make a plan for how to file their taxes and included a link to the IRS website. For all of the email development and implementation, I again just want to note how great everyone was to work with at the university in getting these all designed and ready to send in their systems. That took some effort, and the project would not have been possible without their work and support there. All right, so who were we sending these letters and emails to? Using the university data, we tried to proxy for those who we thought would be eligible or likely to be eligible for AOTC. So these were sent to undergraduate students who were US citizens enrolled at least half-time in at least one term in 2019, and excluding people who were missing key information or likely already had a bachelor's degree. Given the nature of how the treatment was going to be implemented, with contact needing to go out from the university system, the randomization was done with their data. That is, we weren't in a position to use IRS data to get a finer grain look at likely eligibility on the front end, just in regard to how our various data sharing agreements were structured. However, we had a great sense of enrollment since we were working directly with the university data. I want to note that we group students with similar characteristics into blocks on year in school. And if they were enrolled in the fall 2019 term, whether or not they had an authorized payer registered with the university. And we then randomized within those blocks. So we had about 19,000 students in the study, and they were placed into either the communication bundle or the business as usual group. Within the communication bundle group, we further randomized into the letter sender either being the university or the IRS. So that's 50% in the control, or about 9,500, and 25% in each treatment arm, about 4,700. I should also note that for those who had an authorized payer, if that person had provided an email address, the authorized payer also received the emails in the communication bundle groups. The letters were sent to students' permanent addresses. Okay, our main research question focused on whether or not the communication bundle increased take-up of AOTC. And we tested that with an OLS regression, including some student-level characteristics as covariates and block fixed effects. Our secondary research question was more exploratory in nature, as we knew we'd be underpowered for that. We were interested in testing potential messenger effects, and we also tested that with a similar OLS regression, including indicators for the senders. Turning to preliminary results, the pooled effect of receiving either communication bundle significantly increased take-up by 1.5 percentage points. So that might not seem like a lot, but it is in line with effect sizes coming out of various nudge units. So UC Berkeley has a working paper where they conducted a meta-analysis on this kind of intervention that covered 24 million people, and they found an average effect size of 1.4 percentage points. To put this in a different context, as a thought exercise, if we were to scale our results to if we had contacted all undergraduate students at a degree granting institution, we could potentially prompt an additional 320,000 AOTC claims. If we were to focus specifically on undergrads at a public degree granting institution, that'd be about 250,000 additional claims. And certainly not everyone in those examples would be eligible, but just to kind of give a sense of how a small effect size from a low cost intervention could really impact a lot of lives. And breaking that out by letter sender, we did not see a difference between the communication bundle with a letter sent by the IRS versus the one sent by with a letter sent by the university. Comparing those treatment arms to the control, the IRS letter bundle was statistically significantly different from the control condition and increased take up by 1.7 percentage points. The university letter bundle had a marginally significant difference from the control and increased take up by 1.3 percentage points. Again, the two bundles were not significantly different from each other, but this suggests that universities may be able to aid their students directly and that the IRS component may not be necessary to see more students taking up AOTC. It would be interesting to do a follow-on test like another study looking at whether a series of emails on their own would be enough to prompt take up, or if that varied mode of communication is important for seeing the effect. Obviously, keeping it to email would be cheaper in the long run than including a physical letter. All right. As I mentioned, we are only sharing very preliminary results at this point. We certainly have a lot more data available to us. We are aiming to delve into preparation method. We're also very interested in looking at filing status and timing of filing. The outreach kind of across the board encouraged early filing and included information on how to file in general. For students who were formerly claimed as a dependent, that could have encouraged independent filing. And especially given that this study fielded during the outset of COVID and that first round of economic impact payments, looking into the timing of filing and filing status will certainly be of interest. We also plan to look into the email engagement metrics, looking at which emails were opened and by whom, and which links were being clicked could be very informative for designing future outreach. And we also have educational outcomes to look into. Situating our preliminary results in terms of the current IRS strategic plan and the response to the Taxpayer First Act, this study leaves us better informed on how to potentially empower and enable taxpayers to claim credits to which they are entitled, as well as a view into options for timely communication and potential communication partners. To address the communication partner aspect, universities, community colleges, technical and trade schools, they all have robust communication systems, and they may be an effective way and a ready partner for disseminating important information. All right, that brings me to the end of my content. So it is my pleasure to now introduce Kahoa Bonham to start the next presentation.
I think my screen got shared, but it's not supposed to be me yet.
At Kahoa's presentation. That's his name. Kahoa, are you on the line?
Yes, I am.
Hello.
Can you hear me?
Yes, we can hear you. Can you take control of the slides?
Yes. Let's see.
Should be able to click on the screen. If not, I can click through the slides for you.
No, I got it. I was just trying to turn my camera on as well.
No problem.
But I assume you cannot see me right now.
We can, yes, we can see you.
Oh, you can? Oh, great. I'm so sorry.
Okay.
All right, I'm ready. So today we'll be presenting the customer experience for small business self-employed taxpayers. This is a consolidation of a lot of research. We're looking at a high level and trying to create a narrative and a visualization of this target population, given that we have such a dense resource at our disposal, that being the number of research projects that we lead here. See if I got this. Okay, overview. All right, so within SBSE research, we have quite the inventory when it comes to projects that capture the SBSE taxpayer experience. So here we're looking at getting a deeper understanding of the experience by integrating a series of different types of research, including focus groups, and analysis of taxpayer phone calls, survey data, and journey maps, which are already a consolidation of a lot of different data resources. So the outcome of that is that we will have identified the improvement opportunities for SBSE taxpayers. So looking at who this target population is within the SBSE segment, we're looking at 57 million SBSE taxpayers, the majority of them being from the Schedule C, E, or F filers, followed by employment tax return filers. This accounts for a third of the overall taxpayer base. Excuse me if you hear my child in the background. So when looking at the preparation of tax returns, tax preparers are a very important part of this tax ecosystem. And when looking at the distribution of self/spouse versus the CPA/tax professional, business tax returns are less likely to be self-prepared than individual tax returns. And that's from our customer experience, expectations, and needs survey. There's about 4,000 respondents to that survey, also known as the SEEN survey. Listen, I'm trying to tap this slide here. All right, here we go. In thinking about the gap between awareness and use, it's important to remember that not all taxpayers need to contact the IRS before filing a return. But here we're looking at the overall awareness of IRS service channels versus the use of these service channels. Overall, the awareness is high, as you can see, for visiting the IRS website, calling the IRS toll-free line, contacting the IRS by mail. If they were aware of these service channels, the use among those who are aware, you can see the distribution is highest for visiting the website, followed by the toll-free line and mail. 35% indicated that we use the IRS to go app.
Working, I can just click for you if you say next slide.
Okay, next slide. This doesn't seem to be cooperating. Okay, so the SBSE taxpayer subpopulations that we identified when looking at the SEEN survey distribution were the balance due taxpayers at 17%. 25% of the respondents were employment tax filers. 15% of respondents were gig workers. 9% were Spanish preferred, and 21% were new SBSE taxpayers, folks who have been in business for less than a year. Next slide. So when looking at our balance due survey responses and the service phone calls, they indicate that taxpayers generally prefer to complete their tasks online. So in the SEEN survey, the IRS channel used for getting tax information IRS.gov accounted for 93% of respondents, while it was 9% of respondents for telephone line and 5% for IRS phone office. Also, an analysis of 323 phone calls that were analyzed between December 2019 and February 2020 indicated that many of the taxpayers that called the IRS telephone line did so after first trying to resolve their issue online first. Next slide, please. Employment tax returns have the lowest e-file rates among business returns. This is a major focus of a lot of our work. This subpopulation is defined as taxpayers who file any employment tax returns. That's the 944 tax return, the 941, the quarterly federal tax return, and the 940, the federal unemployment tax. So when looking at this distribution, we see that for the 944, the distribution of paper is much higher than for the 940 or 941, but either way, we're looking at very low e-filing rates. The external factors that we've identified that impact e-filing are the perceived ease of paper filing and payroll software and pay preparers encouraging paper filing. So a lot of these taxpayers have already been filing with paper throughout all their tax filing history and already find it easy to do. And they encounter any barriers to entry regarding e-filing, and it's very easy for them to self-select out of the process. Next slide, please. Next slide, please.
Looks like it might be frozen. 1 second. Having some difficulties here. Just one.
Well, at least it's not just me.
Is that the right one?
So we'll move on. Back one, I believe. Slide 10. So each household. So yeah, there we go. Perfect. So we looked at our journey maps, our employment tax journey map, and the SEEN survey results to reveal the common pain points experienced by SBSC employment tax filers. The primary, most common themes here are searching for tax information. Move back to slide 10. Move forward one. Okay, perfect. Searching for tax information and making estimated tax payments. Taxpayers seeking information on their tax liability and required forms are likely to encounter multiple perspectives who may provide information with varying degrees of accuracy. Sources might include preparers, financial institutions, friends, family members, and other business owners. And it's likely that before seeing any IRS website links, they will see links for ads. The risk of using inaccurate information is highest for new business owners who would benefit most from proactive outreach and education. Estimated tax payments, the business owners may use tax preparation services and software that are not approved for e-filing. And in order to use EFTPS and modernize e-file, the respective PINs for those services must be obtained in time to make the estimated payments. The registration process may take too long, or the PIN application may be rejected. Business owners are not equipped often with a system that triggers payment reminders or account flags. Now, that's across the board. Business owners are not equipped with a system that triggers payment reminders or account flags. Next slide, please. So our next subpopulation is the gig workers. Gig workers differ from the overall SBSC taxpayer demographics. The scene survey question used to determine whether a respondent was a gig worker was, did you have income from gig or sharing economy work in 2019, such as rideshare driver, pet sitting, rental host, or other on-demand services or goods. We spent a lot of time making sure that we covered our bases when it came to the definition of gig work. So 47% of gig workers are under the age of 35. 33% of their income is less than 30K, and that's 10% higher than all respondents put together. The income for over 75,000 for gig workers is similar to all SBSC respondents. So you can see that the lower the income, the more difference we see demographically. Next slide, please. So focus group discussions and journey mapping uncovered important aspects of the gig worker experience. When we plotted out the phases of the gig worker journey, a lot of things popped out. Primarily, instead of using IRS resources, gig workers generally turn to Google, social media, tax professionals, and family or friends for answers to their questions. One of the biggest challenges that gig workers face is identifying what is considered taxable income. Gig workers need more guidance on what qualifies as acceptable deductions, and gig workers want more advice on record keeping. Next slide, please. Our next subpopulation is the Spanish preferred taxpayers. They differ from the overall SBSC taxpayers in several key demographics. The number of Spanish preferred respondents to the scene survey was 378. Spanish preferred is not equivalent to the same thing as a limited English proficiency. Just keep that in mind. A larger percentage of Spanish preferred were within the range of 25 to 54, 75% versus 54% overall. Income range of 29%, income range of 30K is 29% lower than all other respondents. And only 3% of the subpopulation was over 150K. So keeping these demographic differences in mind is particularly important when it comes to outreach and proactive communications. Next slide, please. In addition to demographic differences, there were differences between Spanish preferred and overall SBSC respondents in IRS related issues. Spanish preferred were more likely to use paid preparers like independent accountants, CPAs, tax preparers at a tax preparation service or another paid professional. And they were more likely to use the toll-free line. They're more likely to receive a notice. And notably, they're more likely to desire outreach from the IRS, going back to my earlier point. Next slide, please. As reflected in the 9-4X employment tax journey maps, taxpayers may start a business before fully considering the necessary record keeping and liabilities and tax liabilities. So self-reported knowledge of tax laws is lower for new SBSC taxpayers. You can see that those who are in business for less than a year, the rate of not very knowledgeable is at 32%, and not knowledgeable at all is at 23%. You see quite a jump for those who are in business for 1 to 3 years, with those rates being at 8% and 31%. So very important to keep in mind as well when it comes to proactive engagement with these taxpayers. Next slide, please. Self-reported knowledge of record keeping for these new SBSC taxpayers was lower than those who were more experienced. So you can see that steep incline For example, this quote from our focus group participant, "I wish I knew how important it was to keep receipts, keep your paperwork, and keep everything filed." The percent knowledgeable is the percent of respondents that either were very knowledgeable or somewhat knowledgeable. But you can see that this jump between 1 year and then 1 to 3 years is pretty severe. Next slide, please. So several things to keep in mind as we continue these research efforts and add more. The Taxpayer First Act was passed by Congress in 2019. The overarching objective is to improve IRS operations. And the major component is a requirement that the IRS develop a comprehensive customer service strategy. And so we have to consider how these provisions impact the SBSC taxpayer experience. We are already, on multiple developments teams and initiative teams in a research support capacity to serve these provisions. In addition, we need to consider other SBSC subpopulations. Our review of multiple research projects has uncovered the important SBSC subpopulations. There may be additional ones. Identifying and studying these subpopulations within SBSC can enhance outreach and other improvement efforts. And changes to filing and reporting and the payment thresholds as it relates to some of these provisions or modernizations and changes to available services in accordance with TFA may also create additional subpopulations that we need to study. But yeah, our goal here was to consolidate a range of research to create a cohesive vision about this target population and some of the subpopulations, and we'll continue to do so. But that concludes my presentation. Thank you very much. And now I'm open for questions.
Next presenter is Yan Sun.
Thank you, Christine. My name is Yan. I will present whether annual federal employment tax returns effective and economic analysis of filing, reporting, and payment compliance associated with Form 943 and 944. This is a joint work with staff, Nihan, and with contributions from Barbara Sandro, Mel Hardley, Terry Mans, Lindsay Schrock, and Tiffany Zaraj. Okay, here is, sorry. This research is part of a broader project of Innovation Lab assessment of effectiveness of Form 943 and 944. Our research has been greatly supported by the Innovation Lab and the team members. And we also get substantial support from the business teams, operation teams in the business. So here's the context. Employers use Form 941 to report wages and tips they paid and federal income tax withheld, and employees share and employers share of Social Security and Medicare tax. Form 941 is filed quarterly. So to ease the burden of filing quarterly, the IRS provides certain groups an alternative filing option, annual instead of quarterly. So farm employers who hire agricultural workers are permitted to file the annual Form 943. This form was implemented in 1956. And small employers with annual tax liability equal $1,000 or below are permitted to file the annual Form 944. This form was introduced in 2006. So here's the motivation of this research. So the goal of annual forms is to reduce taxpayer burden and to improve the tax compliance. However, more and more issues regarding Form 944 emerged since it was introduced, including the incorrect forms filed, untimely filing, high risk of potential lost revenue, and IRS limited resource has been overburned. So our main question is, has the burden of the annual filing outweighed its benefits? We have two major research goals: assess the effectiveness of the annual employment tax forms 943 and 944, and we provide a data-supported evidence for the potential regulatory changes. Research approaches. We conduct comparative analysis of the annual forms 943 and 944 to provide a better understanding of the annual forms filing. We provide sufficient statistics to characterize the annual filing population and to examine the filing behavior using the administration data. We develop an empirical model to quantify the tax payment non-compliance. The data we use is the compliance data warehouse data. We use both the business return transaction file and the business master file. Here's our overall pictures. So this slide shows the total return of employers who filed the employment tax return 941, 943, and 944, respectively, from the tax year 2006 to tax year 2017. So Form 941 is shown in the background. So we find the total number of employers who filed the Form 941 has remained at a relatively stable level, around 6.2 million to 6.6 million. And we find Form 944 filings has been in steadily decline over the last decades. Form 944 is represented by the red line. In tax year 2006, a total of 360,000 employers filed Form 944, but this number declined to only 67,000 employees in tax year 2017. So comparatively, Form 943 filing is comparatively stable. It's the black line. It's much flatter, and we also observe in recent years the divergence has grown wider. So this slide shows the filing pattern. In the left panel for Form 941, it shows approximately 10% of the employers who filed Form 941, but they have had an annual employment tax liability equal $1,000 or below. In the right panel, it shows the Form 944. On average, approximately 28% of the employers who have filed Form 944, they have had an employment tax liability equal to $2,500 or above. So this implies that the majority of small employers, they will continue to file Form 941, even though the annual Form 944 is an option. On the other side, a non-trivial number of large business, they will continue to file Form 944, despite they have annual tax liability over $2,500. So this slide presents the average income tax withheld and Social Security and Medicare tax, respectively, for Form 944 in tax year 2017 by the deciles of total wages and compensation. So we find around 60% to 70% of Form 944 filers, they have annual employment tax around $1,000 or below. And look at these top deciles. The top decile of the Form 944 filing population had a significantly higher tax liability than the rest of deciles. So the heterogeneity in Form 944 tax liabilities contradicts with the original goal of the Form 944 to be filed by the smallest employers. And this is also shown clearly in this slide. So this is a truncated distribution of tax liability of Form 944 filing in tax year 2017, with the tax liability equal $10,000 or below. The red line is the eligibility threshold of $1,000. So we find approximately 12% of Form 944 filers in tax year 2017 had an annual tax liability over $10,000. The distribution of Form 944 is highly skewed to the right. In the next couple of slides, I will talk about the tax compliance. So the first slide in compliance I will discuss is the tax reporting in the incorrect tax form. So the left panel is for Form 943. Around 2% of Form 943 employers filed Form 943 but had no Form 943 filing requirement. Conversely, about 41% of Form 944 employers filed for Form 944, but with no Form 944 filing requirement. So we also find, we break further the group into the three tax liability groups. We find as Form 943 annual tax liability go up, the rate of filing the incorrect form goes down. Look at that, from the 6% to 3% to 1%. For this group, the large business in Form 943, they have the lowest of filing the incorrect form, only 1%. But the pattern for Form 944 is completely inversed. As the tax liability goes up, the filing the incorrect form goes up. And for this group, the large business filing the Form 944, this rate is 86%. In compare with this only 1%. So we want to highlight Form 943 filers were more likely to follow the IRS filing requirement. So this slide shows the timely filing delinquency. The left portion of the slide, we notice the filing delinquency is the highest for the Form 944. It's 9%. And then it is only 2% for Form 943. Then we break the filing population of each of the form into three groups. We find the Form 944 filers with higher tax liability were less compliant in terms of timely filing. The timely filing delinquency is 17% for the groups with annual tax liability equal $2,500 or above. It's 17%, 3 times more than this group. So this slide shows the payment delinquency rate. Look at this red mark. This is the payment delinquency, overall payment delinquency rate for each of the 3 forms. For Form 943 filers have the lowest payment delinquency rate, about 2%. And this rate is doubled for Form 944. So we find the tax liability correlates with the payment delinquency likelihood. On average, employers with higher tax liability are more likely to have a balance due. Form 944 filers with tax liability equal $2,500 or above had the highest rate of payment delinquency. So this slide presents the unpostable returns corrected, posted, and captured by CDW data for Form 941 and Form 944. So the left bar is for the Form 941. So we find a total of 34,000 unpostable corrected tax return for Form 941, but they only account 0.1%. And when we look at Form 944, we find a total of around 8,000 unpostable corrected tax return for Form 944, but they account for 12%. And the high rate of the Form 944 unpostable corrected returns generate the cost and burden for both the taxpayers and the tax administrations. So the next I will talk about is the empirical estimation. To quantify the tax non-compliance, we employ a logit model to relate the characteristics of the annual filers to the probability of their fail to pay the tax due on time. So in the first equation, the log odds ratio is the linear function of our set of explanatory variables. F is a form of Form 943 or Form 944, and the P is a probability of tax non-compliance of employee I for Form F. So when I take the antilogs of the both sides, I derive the equation to predict the probability of tax non-compliance. Y is a binary dependent variable. It takes the value of 1 if the employee I who files the Form F have a payment balance due. It takes the value of 0 otherwise. And our independent variable includes the size of the employers, the 3 tax liability groups in dummies, and the industry sectors and the geographical location. So this is our empirical result. So our primary interest variable is a dummy for the tax liability groups. It is statistically significant and positive. It indicates that the larger tax liability exhibits a positive correlation to filers' probability of tax balance due. And we want to highlight employers with larger tax liability tend to be more delinquent in tax payment in both Form 943 and Form 944. And the odds ratio is also shown in this table. So we compare the odds ratio of Form 944 and 943. We find employers filing Form 944 have a higher odds ratio for tax payment delinquency. So here's our interpretation from the empirical model. The implementation and processing of Form 944, whose eligibility is based on the employer's annual tax liability is more complex than Form 943, whose eligibility is based on the industry sector. Form 943 and 944 payment delinquency is positively correlates with the employer's annual tax liability. Large business that file Form 944 are approximately twice as likely to have tax due non-compliance than large business that file Form 943. So here's our finding from this study. We confirmed the problems identified by IRS subject matter experts. We observed divergent trends for the filing populations of the annual form. We identified the Form 944 has not been widely adopted by small business since its introduction in 2006. We found a non-trivial number of large businesses that filed Form 944. Even Form 944 was designed for the smallest employers. We demonstrate that Form 943 filers exhibit less filing confusion than the Form 944 filers do. We showed that Form 944 filers with larger tax liability have a higher rate of tax non-compliance. The policy recommendation. So we recommend to eliminate Form 944, and we recommend no change for Form 943. Thank you very much. I will turn it over to Jacob.
Okay, great. Do I have control here? Great. Thanks so much. Those were an interesting set of papers. Going through in order. So there were just a bunch of really impressive things in this paper. So the methodology, a randomized controlled trial is kind of old hat for IRS research, but it's just that's so unique among federal agencies where IRS has really been a leader in this regard and sort of a good model for others. So that's nice. The collaboration is super impressive. The researchers have not one but two administrative data sources they're using, and this trusted messenger in the university who knows the situation on the ground and can be an input into designing the intervention. And then the ability to link the results to the IRS data on the back end is very cool. So those together. And then finally, the main research question about AOTC take-up is interesting and policy relevant. But the intervention is also well suited to study implementation questions about which type of messengers are most effective, which is just relevant to hundreds of interventions of this type. So here the results are imprecise on that, but they could still go into a meta-analysis with other studies, and it could still be useful. And then last, the design process, that we saw in the presentation is also a really nice model for IRS communications, where they're looking through how it shows up both on websites or on mobile, talking through focus groups to understand how it would be perceived. So there's a lot of really nice things here. Okay, so in terms of the broader context, I would like to see a little bit more here. So my first suggestion is to present more information to situate the intervention. In the presentation, I think it was mentioned that maybe take-up of the AOTC, other studies have found about 50%, but presenting those statistics directly would be, using the information returns would be really nice. So basically thinking about the take-up rate as the share of people who claim the AOTC or some other education benefits over the total number who are eligible to do so. And you can't observe that perfectly in the tax data, right? Like you don't know every eligibility factor, like whether somebody had a drug conviction, but you could get pretty close using the 1098-T information returns. And that'd be nice because it would be a way to understand the magnitude of the effect, right? Like if the take-up rate is only 50%, how does that tells us whether this like 1.5 percentage point effect is big or small, right? Is it like really covering most of the gap, or are there other sort of barriers that are doing most of the work? It might also be nice because you could then condition in your sample on people who appear eligible to claim the AOTC, right? Even though you couldn't do that on the front end when you were sort of assigning the treatments, that could still be done on the back end for the analysis. And that would be a good way also to like understand and interpret the magnitude of the treatment effect you find. A related point is that it would also be nice to compare the sample of students from this particular university. The name was sort of mysteriously withheld, but I like that sort of cryptic aspect, to the overall population. And that would help with questions of external validity. So like, is the take-up rate of students at this university similar to the take-up rate of all students in the country? Okay, so another, I think, big question is how this question of AOTC take-up interacts with tax filing more generally. And we know from other credits and take-up studies that they're usually very closely combined. Like, so for the earned income tax credit, right, most of the people who don't take it up just don't file a tax return. And that would be really interesting to know for the AOTC, both sort of as part of the broader context, and also to, again, sort of interpret the effects of the intervention and the margin on which it's sort of operating. And this matters a lot in terms of thinking about what types of interventions are likely to be effective, right? You could have informational messaging like this, but it's like pretty hard. It's like a complicated credit. So you could, and students have other stuff they're trying to learn. So you just might like hit a wall in terms of people's sort of attention and ability to absorb this information and remember it by the time they like are doing their tax return. But if everyone's just filing electronically, maybe it's enough to just like get them to file an intervention to like get them to file a return, and then they're going to claim it if they're eligible. And it also matters whether the goal is just to get people to claim the credit, like if they're already students, as opposed to some of the like the other goal of the credit you meant, that was sort of the focus here is awareness is important if you're trying to get people use the credit to get people to enroll in college who wouldn't otherwise be going to college. So if that's the policy goal, then a different set of interventions would be better. And then also last point is there could be interesting spillover. So if the interventions increase filing, this type of intervention by telling people about the AOTC, they might now start claiming other tax credits that they're also eligible for. Okay, just very briefly on other comments. I'll follow up with this, but there's other subgroups you could look at to test some interesting hypotheses, I think. Okay, so turning to the second paper on the SBSE customer experience. So this was a really nice improvement over prior work. So prior work and research in this area, as I understand it, has been, it's not like this is the first time to look at customer experience in SBSE, but before the survey, it was pretty much focused on people who contacted SBSE. And so you're getting a pretty skewed picture for sort of the overall effectiveness of a lot of these methods. The other nice thing I really liked about this is there was a lot of mixing of both quantitative results from the survey with qualitative insights from these focus groups about what worked and what didn't work. And it's also nice that there's obviously like so many different diverse groups of taxpayers who are part of SBSE, right? Like anyone who has like an LLC, for example, is very different than somebody who is a gig worker, like driving for DoorDash. So one thing the paper is really nice on is they're very careful to dig in and not overgeneralize across these different groups. In reading the paper, though, I was sort of struck by the messages sort of clashing a bit here from these two different sources. So like most of the survey takers seemed like pretty on top of things and satisfied with their experiences. But then for the focus groups, I mean, admittedly, it's a smaller end, but many of the quotes at least emphasized, confusing aspects of the process, like how it was hard to get assistance with the online tools and, like they needed to use the online tools because they couldn't get through on the phone. So, just reconciling those, I think, would be nice in the paper. One thing about the survey is that, so just taking one figure that was in the presentation about awareness rates from the survey. This is sort of what I mean when I say that they were on top of things. Like these are very high awareness rates. I was kind of blown away actually that people sort of knew this stuff so well. Like 1 out of 3 taxpayers knowing about the IRS To Go app. I like spend, I'm like at this conference, I like to think about the IRS a lot, but I didn't really know about the IRS To Go app. So like, I think the concern that sort of raises though is relates to selection, which would be the idea that the people, even though the survey is a random sample, like probability sample of all the US population, the people who decide to participate would be the ones who are more interested in the IRS or who enjoy talking about this stuff. And then the concern is that the responses wouldn't generalize to the whole population and might actually paint too rosy of a picture on customer experience. You could look into this more by comparing the respondents to the overall population, understanding, and some more details would help. Like, what was the response rate? They talk about doing some sort of reweighting, but it would be better to understand sort of more details about that. And even if you're sort of basing it on demographics, you might not be able to reweight based on these other sort of unobservable concerns. And then just, I don't know if there's a ton to do about that, but even just like discussing and thinking about the direction of the bias, I think would help a fair amount to alleviate some of those concerns. Okay, and again, I could follow up. I think there's some other sort of interesting things to do here about linking survey and administrative data. On the last paper, again, really interesting, just to sort of like make clear sort of like what's at stake, right? It's about, if you're an employer and you have to, file one of these returns for withholding, is it annual or quarterly? Do you have to do 1 a year or 4 a year? And the idea is it's less burdensome for most people to only do 1 a year. That's the 944. But in order to qualify to use the 944, the rule, as I understand it, is basically your tax liability for the year has to be below $1,000. I think I'm remembering that right. But so, one thing I think would be helpful is to frame this in a take-up framework. It's not a normal sort of tax benefit like the AOTC in the first paper, but a similar, I think you could use a similar framework to sort of help clarify some of these trends. So you could take the whole population of taxpayers who are eligible to, who have a tax liability low enough to file the form 944 and see what share actually do. And it looks, if I'm reading that, maybe I'm misunderstanding something, but from the table in the paper, it looks like only 4.2% of taxpayers who are eligible to use this form are actually doing so. So that's pretty striking. The other nice thing about focusing on take-up is it's a natural way to compare industries and over time where there could be changes both in eligibility as well as participation. So it sort of takes those together. And then last is it also sort of suggests that you can maybe gain something by focusing in on taxpayers who have a tax liability low enough to use the 944, but who are not participating in it, to try to understand some of the barriers and why they're not using it, or some of the specific compliance risks. Okay, so there's this sort of like very striking pattern of declining use, like number of people who are using the 944 over time, in contrast to the 943, which is for farm workers, or for farm, sorry. I don't know that the comparisons between 943 and 944 are so informative because it's just such a different population. But thinking just about the 944, like I tried to think of some reasons why we might see this declining use. One is that it seems like in order to use it, you have to get prior approval from the IRS. And it seems like you see a decline starting in around 2008, 2009, and right around when some of the budget, I think some of the IRS budget cuts started to kick in. So maybe if either it was harder to get pre-approval or sort of wait times went up. So that might be one thing to look into. Another one, this third bullet point here, is that I sort of like put on my lawyer hat and looking at this and was interested in sort of where these rules were coming from. And at least in the temporary regulations, when the program was created, it suggested that IRS was actually going to conduct outreach to at least a lot of the employers who are eligible to use the 944. So maybe initially participation was very high because of that outreach, and maybe it wasn't repeated again. But that could explain sort of the declining pattern in use over time. And then last, the authors talk about policy reforms. One, in the presentation, the one that was focused on was just eliminating the 944, and I'm not sure exactly how the results that were presented here directly justify that, because it is less, burdensome for a lot of taxpayers potentially. But another one that was in the paper was to raise the eligibility threshold above $1,000, and that could sort of maybe make it better so more people could participate and only file one form per year. Another idea to maybe raise take-up is to remove the requirement for prior approval by the IRS. Right, if you have to wait, if you're a new business and you have to get prior approval, and if there's a delay there, it's just not that helpful to you. You're already going to sort of figure out how to do the quarterly filing, and so maybe you just never avoid the cost in the first place that way. And you could just imagine a system with individual withholding where if you sort of don't do it quarterly, even though you're supposed to, and you don't meet the criteria for annually, then there might be some penalty that you would get in that case. But you could sort of cut out that middle step, which is presumably burdensome for the IRS as well. And you could even make it more predictable by saying it's not only your current year tax liability or balance due that matters. It's also if last year's was low enough, you would also be able to use the annual approach. And then I was also just interested, in sort of what needs to be done here. And I think the paper talks about new legislation, but as far as I could tell, this is just something in the regulations. So, IRS could just change this on its own. But again, this is such a great study and such a great model for for making policy at IRS, right? Where you've got sort of, this is all laid out in the paper where, there are subject matter experts who have sort of anecdotal concerns with a form, and then combining that with sort of a systematic empirical study is a really nice way to get at a policy conclusion like this. So that's it. Thanks.
Thank you. So I first hand over to the presenters to see if they want to respond to the discussant. So Anne?
Yeah, so thank you, Jacob, both for your kind words and for the feedback. As you could probably tell, we were very much in the early stages of digging into things, and getting your perspective on some areas to focus moving forward is very helpful. Situating our findings in the broader national context of take-up, it's definitely on our radar. And we certainly appreciate your other suggestions for looking at our sample in terms of demographics of the larger population and in terms of where we saw movement and take-up and that sort of thing. Regarding your comment on non-filing, we were and are planning in general to look into whether or not the intervention prompted filing. And we haven't tested that yet, but in both the treatment and control groups, just looking at the rates, non-filing was about 9%. So we're not expecting to see an impact of our treatment in terms of promoting filing among those who would otherwise not file. But it's something that we'll look into a bit further. Just in general, thank you again for your suggestions. We'll definitely take all of your feedback into account as we refine our work.
Well, first, I just do want to ask people to submit any questions they have for any of the presenters through the Q&A, but then on to Koa. Want responses to make? Seem to be having some technical difficulties there. So Yan?
Thank you, Jacob. Your comments are very helpful. I really appreciate that. So yeah, I really like the take-up rate. Definitely we'll look at that in the revision. And for your comments on like the employer not participate like the non-filers, we didn't look at that because we use the return data. So whatever they filed and assessed, we can see it. Otherwise, we just don't have the information. And then you mentioned the like why it's going down. I think in 2010, IRS like changed their policy between like 2006 and 2009. It's IRS, like I think you are right, like reach out, like the IRS decide who is eligible. But after 2010, the policy changes. Employer, they can opt out. They elect to choose Form 944. But I think you are right. Definitely, I should look more on the policy on the qualitative insight, like what's the history happen from the year 2006 up to now, like how's the policy make it more clear for the audience. And you mentioned like the prior approval. I think this is a really good point. This is also the key, like for the recommendation. But currently, the background of this research is the SBSE, they are currently reviewing the policy recommendation. We are not in the, like they are reviewing our recommendation. I think they will take care of the second step, how to implement the policy recommendation in like a more detailed way. Yeah, so I would definitely consider all these comments and incorporate in our next revision. Thank you so much for your kind words and for your comments. Thank you.
Okay, say again, if you have questions, you can put them in the Q&A box, but let's see. So this is for Anne. I know you probably didn't do any testing on the additional characteristics of students that you included in the model. Was there anything interesting in that jumped out at you?
That's a fair question. Nothing yet. I'm sure we'll have more to share in the future on that.
So, and this is for yeah, and it's both a I think starting out with a comment about the decline in 944, that it does generally seem to be pretty inconvenient for everyone involved, since you can become technically ineligible for it, and yet it remains your filing requirement unless you take active steps to change that, and then where are you? And then I guess the question, do you know if there's ever been any consideration of automatically changing the filing requirement if people go over the limit? Doesn't happen, obviously, but
I think the question is exactly the motivation for this research. the original goal is to improve the compliance and to reduce the burden. But in the real implementation and processing, a lot of questions, issues emerged, including what you said in the comments. I think for us, we did the research, and the SBSE, they are currently consider the options because they really know the business. So they are doing the next step. But from the research, it's apparently 944 is based on the tax liability. But from our empirical analysis, the tax liability changes not very often, but very sensitive. Whenever we have the covariate risk, like the natural disaster or idiosyncratic risk, like the health of each employer, like the tax liability changes because the production shrink or expand. But IRS filing requirement is not so responsive, and the employer only can submit their filing requirement change in the first quarter of each year, and then IRS, they will process it. And so it's more complicated than just like it's very complicated. So I think as short answer is SBSE, they are currently considering the different option. Thank you.
Thanks. So one more check to see if we did we get Kahoa back to make any discussant responses?
Yeah, I'm back. Hello. Sorry about that. If you could, because I don't have anything listed in front of me, and when I look at the chat, I don't see the topics listed. Could you refresh or restate one of the questions posed? Because I don't see anything here.
Just to respond to the discussants.
Okay. Well, I'm sorry. Oh, that was the comments that were just mentioned just now.
Yeah,
verbally. Okay, I'm over here looking for
from
notes or whatever. Sorry about that. Okay, so we're focusing on, in terms of next steps, we're talking about more focus group efforts and incorporating additional survey results per the subpopulations that were identified. So, I mean, that's in terms of next steps. I'm not sure if I'm addressing his question specifically.
Okay. Well, I think that wraps up all the questions we've got. So I will hand it back for the sum up.
Well, I seem to be unable to start my video. Can you hear me?
Yes, we can hear you.
Okay, looks like I'm.
We can see you too.
Looks like I've been let back in. Okay. So I just wanted to conclude the program and thank the many people whose efforts made this conference possible. The program committee this year was Terry Ashley, Brett Collins, John DeToma, Javier Framanen, Connor Kitchens, Patrick Martin, Christine Ohlert, Melanie Patrick, Alan Plumley, and Larson Silbaugh from the IRS, and Rob McClellan from TPC. Thanks also to Alan for taking the lead on arrangements from the IRS side. From the urban side, a big thank you for the organizing and logistics that made everything run smoothly. To Ann Clevin from the Tax Policy Center, and Ivy Hunter and Aaron Coons from Urban's events team. I'd like to thank all the panel presenters, discussants, and moderators who did such an excellent job, and Charles Reddick and Mark Mazer for presenting our keynote addresses. And a special thank you to Mary Helen Risler, who filled in as a moderator on very short notice due to a medical emergency for the original moderator. And last but not least, thank you to the audience and for all the stimulating questions, and especially to the 160 of you that are still here after a very long day. I look forward to Urban hosting this conference in person this year, and that concludes today's program.